City, I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief, brought to you by Invesco.
Good morning, everyone. Let's get to the three things that you need to know today, starting with the markets. Stock futures rising this morning, building on a bout of rate cut optimism that lifted stocks to some record highs that we saw at Monday's close. Wall Street's tracking commentary as well from the Fed all week long. And Fed Governor Michelle Bowman, who cast the lone dissenting vote at the Fed's September meeting, speaks today. Fed Chair Jay Powell scheduled to speak on Thursday, and there you see the entire host of Fed speakers as well.
We've also got China's stock market seeing its biggest rally in more than 4 years after the country's central bank released new stimulus measures. Now, those measures including cutting interest rates and also mortgage down payments. The plan is an effort to boost the country's weak economy.
And Boeing workers are rejecting what the company called a best and final offer. The offer included pay raises of 30% over 4 years. That's up from 25% in the company's initial offer. But the workers' union argues that Boeing made its offer without bargaining with union negotiators and that the offer will not go up for a vote. The strike is in its second week. A busy week of Fed speak rolls on with comments this morning from Fed Governor Michelle Bowman. She was the only official to vote against September's 50 basis point cut and the first Fed governor to do so since 2005. Yahoo Finance Fed correspondent Jennifer Schonberger joins us now with more on this morning's comments. Some might call it tea, Jennifer. So what are we expecting to hear? What have we heard?
Good morning, Brad. I need to come up with a nickname for you. Fed Governor Michelle Bowman elaborating this morning on her decision to dissent at last week's policy meeting, saying that by cutting by 50 basis points, she worried it sent the signal that the Fed saw underlying economic weakness. She says with no signs of economic weakness or fragility, she would have preferred to have cut by 25 basis points. She also worried that by cutting by 50, it sent the signal that the Fed would move in that magnitude at forthcoming meetings. But she said she was relieved that Fed Chair Powell reset those expectations during her press conference. Bowman's still very much concerned about inflation, and more so than her colleagues, saying, quote, "I continue to see greater risks to price stability, especially while the labor market continues to be near estimates of full employment." She says core inflation is still uncomfortably high for her and that the upside risks to inflation remain prominent given high government spending and that global supply chains continue to be susceptible to labor strikes and geopolitics. On the job market, Bowman says, although there have been signs of cooling, wage growth is still elevated while consumer spending remains solid. She says her contacts are not planning layoffs and continue to have difficulty hiring. As a result, she's actually taking less signal from official job market data until there are clear signs spending growth and the job market have materially weakened. Now, looking ahead, Bowman says she will remain cautious on her approach to setting interest rates. She says her estimate of the neutral rate, that's the rate that neither spurs nor slows economic growth, is much higher than pre-pandemic. Thus, she believes the Fed is much closer to neutral now and would arrive at a neutral rate sooner if policy was dialed back at a much faster pace. Now, Bowman does say if the job market were to materially weaken, she would take appropriate action. Guys?
All right, Jennifer, thanks so much for breaking that down for us here. Well, beyond commentary that we're getting this morning from the Fed's Michelle Bowman, central bank officials defending last week's half-point cut as necessary to sustain balance in the U.S. economy. Investors now turning their attention towards a slew of economic prints in the weeks ahead that could provide a look inside at the health of the labor market, also maybe some clues on what the Fed is going to do next. Joining us now, we want to bring in Stephanie Roth, as she is Wolfe Research chief economist. Stephanie, it's great to have you back here on Yahoo Finance. Let's talk about the 50 basis point cut. I think a lot of people are looking at this, trying to figure out whether or not this was a preemptive move, whether or not we should be worried about some of that softening within the labor market. What do you think?
I mean, it was probably preemptive to some extent. At the same time, the Fed has a lot of room, right? Rates at 550 with policy estimates somewhere around at least 4%, maybe even lower for neutral. They have a lot of room to go big at the beginning. And also, Powell didn't fully acknowledge this. He kind of danced around the question, but they asked whether we were just catching up from the July cut that probably they should have done. And he didn't exactly say this was the case, but I think you could read from the body language that wasn't what he was implying, that they should have cut in July. They didn't. Now they did the 50 basis point cut. And from here, it's going to depend on the labor market and inflation. And inflation is trending back down towards that 2%. So it makes sense for them to be getting back down towards a policy rate that's closer to neutral.
You know, Stephanie, it's so interesting because as we're seeing right now, Bowman coming out saying that core inflation remains, quote, uncomfortably above that 2% target, seeing greater risk to inflation than the labor market. It doesn't sound like you necessarily agree with that sentiment.
No, I don't. And if you listen to Waller from Friday, he said kind of the opposite. He said he's worried about inflation perhaps missing to the downside. And the more recent run rate in core PCE is running below 2%. So if you look at core PCE, which is in fact their target, and if you don't look at a year-over-year basis, because year-over-year inflation is a little bit lagged to some extent, that's 2.6. But if you look at a 3 and 6 month change in core PCE, you're running below 2%. So they're now, especially with labor market starting to sort of decelerate meaningfully, they're at risk of potentially missing to the downside. And the SEP, or the Summary of Economic Projections, which they put out last week, indicated that risks are now more balanced on the inflation side and skewed to unemployment rate rising from here.
It seems, though, from Bowman that there are greater risks to inflation than the labor market. Where are some of those risks? Are we just thinking about exogenous threats that we can't anticipate, or is there something more broadly that they see brewing right now?
Well, she might be concerned that wage inflation is still running a little bit high because wage inflation feeds most closely into service inflation, which is the biggest part of the inflation basket. But if you look at the more recent trend that you've seen a deceleration in employment growth, then you should expect wage growth to follow as well. You could be talking about some of the one-off factors. So, Boeing strikers potentially getting a boost to their wage inflation, or port strikes potentially disrupting activity. But those things should be temporary, and the Fed should generally look through that. And at this point, the risk of having a labor market that weakens more materially is more significant for the economy than having inflation run a bit high. We've been in an environment where inflation was a little bit elevated, and we kind of were able to pull through that. But if we start to see the labor market really, really melt down, that could be a recession risk, and the Fed wants to avoid that.
So, Stephanie, what's the most important data point, do you think, decide between 25 and 50 basis points? I'm assuming it's the labor market here from your commentary. And then I guess if that is true, and to go a step further, then what is that threshold that you think the Fed is closely watching to decide how concerned they're going to be about the health and the strength of the labor market?
So it's certainly going to be the payrolls print next Friday. So we have a week and a half to sort of think about the estimates there. But our base case is that we're going to see payrolls come in a little bit better than the market is fearing. So the threshold that you were referring to, I would say somewhere between 120 and 130,000 on payrolls. So if we get something that's notably lower than that, that might push the Fed to be more likely to do a 50 basis point cut. If we get something that's closer to that threshold or above, then the Fed might feel a little bit more comfortable just going 20 basis points from here. Similarly, the unemployment rate. If it rises certainly to 4.3, that would be some reason to do a 50. If it rises towards 4.4, then a 50 is almost certain. So it kind of is going to depend on the nuances within that print, but hands down, the payrolls print is going to be arguably the most important thing determining the next couple of moves from the Fed.
At this juncture, is it too early to get a sense of what a terminal rate could look like at the end of this cutting cycle?
I mean, the Fed is telling us it's close to that 2.8. We think it should be somewhere around there as well. Where our base case is that they'll cut at least to 3%, perhaps even by the end of 2025. So now that they're potentially accelerating this cutting cycle, we could easily see 3% in the not so distant future, and then maybe just a couple of cuts after that.
Stephanie, I wanted to take a look at what's happening around the globe, and specifically China. The stimulus measures that were announced this morning, obviously they're doing it in an effort to boost their struggling economy. But I'm curious what you see as the ripple effects on a global scale.
I mean, we've heard this so many times before that China's going to be easing, and there's excitement about the impact on the global economy, and it hasn't played out. So we remain fairly skeptical that any easing moves that they do out of China will be large enough such that it will have a global implication, boosting the global economy. Base case is it perhaps helps to stabilize their economy at the margin, helps to stabilize confidence, but that's kind of it. They're still trying to deal with the bubbles that they have, especially on the housing side, and they don't want to really accelerate their economy meaningfully. So it's likely to be fairly modest. And base case, it doesn't have this global implication, especially from an inflation perspective.
Excellent context and perspective this morning. Stephanie Roth, Wolfe Research Chief Economist. Stephanie, great to have you back on here with us. Thanks so much. Well, sticking with China, its stock market is soaring after the country's central bank made a big move to revive the economy. The CSI 300 seeing its biggest jump in 4 years after the People's Bank of China revealed and unveiled its latest round of stimulus for the first time since the pandemic. Yahoo Finance's markets editor, Jared Blickery, he's standing by and tracking all the moves for us this morning. I'm just waiting for an international heat map to pop up, Jared. Oh, please don't disappoint.
There we go. Come on, guys. You're going to notice something jump out, maybe. We got 4% moves in not only Hong Kong, but also China. Let me show you their benchmark, the CSI 300. This is what happened today. They announced the stimulus measures, took a minute to take off. Here you go. There's a lunch hour. And boom, right after the lunch hour, more gains. And then into the close, up 4%. That is the best day for the index in 4 years. I'll give you a visual on some of the stocks in China right now. Nice smattering. Alibaba up 2%, Pinduoduo up 2%, JD up 4%. But not really big movements in some of these big stocks that we're used to seeing. I want to go over some of the details. These are key. There's a lot in this package right now. And I'm going to go over a lot of terms. Some of them are going to seem strange, but it's basically all monetary stimulus. There's not any fiscal stimulus that I see in this package, and we'll get to that point in a bit. But first, I want to go over the details. The 7-day repurchase rate, that's basically a week-long loan, going to be lowered to 1.5% from 1.7%. That RRR is lowered by the reverse requirement ratio. That is how much banks have to post in reserve in order to make loans. That's going to be lowered by 0.5 point. That should unleash 1 trillion yuan in liquidity. The People's Bank of China not telling us when those reverse repo cuts are going to take effect. Then we have a slightly longer lending facility. That's going to be cut by 0.3 percentage points. We have the minimum down payment ratio for second home buyers. That's going to be cut to 15% from 25%. So they're stimulating their property sector, which has been under tremendous pressure recently, and over the last few years for that matter. And it looks like China may cut the reverse repo rate further this year by another 25.5 percentage points. And that will not apply to small banks, just the larger ones. And then the loan prime rate and deposit rates, those are shorter term interest rates. Those fall by 0.2 to 0.25 percentage points. And then finally, the PBOC is going to cover 100% of loans for local governments buying unsold homes with cheap funding, up from 60%. So that was a measure that was already in place, and we're seeing them tack on to that. I do want to quote Macquarie here. We do have a quote from Macquarie. The purpose of today's briefing is to inject confidence into the market, judging by the fact that the authorities revealed measures in one go. That was all at once. The stimulus push will still need coordination from other policies, particularly follow-up policies from the fiscal side. And that's what I was noting before. There's no fiscal measures in here, but if they do come, that would be kind of the complement. That would be the magic sauce that got us the boost in the pandemic. Now, the risk, of course, is that there's too much stimulus. And we've seen that before. We've seen this with the People's Bank of China many times. Let me go back to our charts here, and I'll show you the historical on the CSI 300. Here we go. The People's Bank of China at various times have tried to revive their economy through monetary stimulus, and it has backfired. They have only weakened their economy, inflated asset bubbles, so they need to figure out the asset side, the fiscal side as well. Here's China once again. I want to show you the 5-year chart. They're down 34%. So the country is in dire straits with respect to their economy, and this is kind of a last-ditch effort, I think, on their behalf to bring them into the fold. I'll add one more point. The drop in percentage points in the U.S. a week or two ago, that gives the other central banks across the world a little bit of wiggle room to do things like that, like this. So that was very important. Guys.
All right, certainly is. All right, Jared, thanks so much for breaking that down for us. We're just getting started here on Yahoo Finance. Coming up, we're going to take a closer look at Yahoo Finance's top movers, stock movers here this morning. That's coming up right after the break. We'll be right back.
Welcome back to Morning Brief, brought to you by Invesco. Now time for some of today's trending tickers. You can scan the QR code below to track some of the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Let's start with Boeing here. Ticker symbol BA. The company said it has made a final offer to striking workers, which includes bigger raises, larger bonuses. But union leadership said not so fast. Offer is just not good enough. To discuss, we've got Yahoo Finance's very own, very fast Pras Supermanian here. Pras, what do we know about this?
Yeah, a really weird story here when I heard about what happened. But basically, you said the Boeing says, here's our latest and greatest offer after 2 days of negotiations between a mediator. But that's not how it works, right? You can't just give your final offer to the union. The union has to actually take that offer and decide whether they want to have the members vote on it. So they kind of try to circumvent that because it sounds like they need a deal fast, right? That's what's sort of happening. And BA leadership is saying, union leadership is like, you know what, not good enough. 30% wage increases, doubling the ratification bonus. Another bonus set of 401k contributions is sort of like not good enough. They want their 40% defined pensions, which is a tough sell right now. But that's really interesting how Boeing just sort of tried to circumvent union leadership here. And I think it speaks to how desperate they are to get this deal done, and that's just not how it's going to work because 90% of workers are really unhappy with that.
Yeah, exactly, and also I think it just illustrates how far apart the two sides are, right? So what is it thought? I don't know if analysts are out with a reaction yet in regards to this, but if they are still so far apart, the risk that then this poses to Boeing and maybe the fact that the union does have the upper hand in these negotiations. Yeah,
I think they do, given what's happening in the world right now, and we saw last year with the UAW getting almost what they wanted there from automakers. So the machinists here think they can do that. But there's also kind of pressure on the union too because of the fact that last paychecks just went out. Healthcare goes out at the end of the month. So there's sort of, how long does your strike fund last, right? And that's sort of the pressure now that maybe there will be the union sides coming to the table more. But right now they're in the driver's seat, I think.
Right. Well, the context in the background here too is when Boeing generates cash, they generate it off of deliveries.
Yes.
If you don't have these workers, then you're not going to be able to deliver on the 737s, the 777s, the 767, 787. That continues right now because that's out of South Carolina. But how long until Boeing has to come out to the street and communicate that it's got to revise its own financial statements and projections at this point?
I think it's a matter of weeks, if not days, when we have to start talking about, hey, actually, we're going to miss these deadlines here. Like you said, they have a bunch of planes that are sitting on the lots there that are constructed and everything, but they need to be delivered, and that takes additional work. And they don't have anyone there on the union side that can do that. So I think that's the problem. And you're right, Dreamliner deliveries are happening right now, but that's not their big moneymaker. It's a 737 MAX.
Should be a lot of space in the manufacturing facilities in Seattle for me to take a tour at this point. Then.
Yeah.
You've been talking a lot about it.
I
think you got to go at this point.
Look, I will strap on some roller skates and do a Yahoo Finance Live, just Twitch stroll around the Boeing facility if they let me to.
Get it on the books.
Roller skating's back in.
Seattle. It's just Seattle.
Yeah, there you
Let's go.
Fulton Fish Market, right? Or whatever.
Yeah, you and Rick do your ride-alongs. Let's do a plane along. How about that?
Take the show live from out there. That's great stuff. Thanks so much. Let's take a look at shares of Boeing this morning. We were talking so much about Boeing. We're going to take a look at shares of Visa this morning. Shares off just about 2%. The Justice Department planning to file an antitrust lawsuit against Visa as soon as today. This is according to a report from Bloomberg. Now, according to that report, regulators planning to accuse Visa of monopolizing the U.S. debit card business. You're looking at losses just about 2%. You might be asking yourself why we aren't seeing more pressure on the stock here this morning. At least when I take a look at a wrap-up of the street reaction here early this morning, it doesn't look like this necessarily is a huge surprise, given the fact that there was an ongoing DOJ investigation into Visa. Many of these analysts seeing it as an incremental regulatory overhang. Citi was out saying that this development isn't a complete surprise, given the ongoing investigation since 2021, and they anticipate Visa likely as a quote-unquote reasonable argument for increasing their debit market competitiveness. So again, it'll be interesting to see how this all plays out. Yes, this could be an overhang here for the stock, at least in the short term, but it doesn't seem like, at least from initial analyst reaction, that they're too worried about what this could mean for long-term projections.
Yeah, two of the things that I think back to, one of them reported by the Wall Street Journal talking about whether or not Visa actually used security tokens, and essentially what that does is allows you to disguise card numbers, basically allowing debit card competition, well, actually dampening debit card competition for payments that happen online. And so that is really really a core focus of this investigation from the Department of Justice as well. MasterCard, they had previously settled such an enforcement action. That was late 2022. And so we'll see to what extent investors still have to pour into this filing from the DOJ when it finally does come forward and we get full details of what is being alleged and what they're going to be looking further into, and then what kind of damages this could mount up to for Visa as well, because I imagine investors are going to try and price that in to the best extent they can at this juncture. Also, let's take a look at the brand of Ghostface Chilla. Snap shares are ticking higher here this morning. You're seeing it up by about 1.2%. The social media company announcing it's integrating Google's Gemini into its generative AI model of Google to power Snapchat's AI chatbot. Now, the tech will be able to understand and interpret text, audio, image, video, and code for users. This is it was actually a really big morning in terms of the announcements for Google. They had a lot of different Google Cloud AI team-ups and announcements. It seemed like they were just taking over the PR newswire. But all that said, this is going to be huge for Snap. Specifically, they're looking to kind of get even more value from this partnership with Google Cloud. They said within this release that since Snapchat deployed Gemini on Vertex AI to support My AI, the company has seen over 2.5 times as much engagement with snapping to My AI in the United States. Now, I have not been on Snap in years, so I'm not exactly sure what My AI is, but I will try it and report back to see what this AI is like.
Yeah, you know, I use it here and there intermittently.
Do you?
But yes, not a ton.
Wow.
Not a ton, I know.
Color me shocked.
Me too, actually. But I do think this is just so interesting when you talk about that huge boost in engagement, right? I think it was almost 3 times. It really speaks to the fact that they are registering with the younger generation. I think Gen Z is still one of the most active users of Snap. So that really shows that if they are able to hook these younger users early, that could mean, could potentially boost their profits then down the line. Also in terms of what this could ultimately mean for the business or how they could expand maybe the use of this. Spiegel also talking about the fact that Snap is considering using Gemini for other features within Spectacle's smart glasses. Remember, that's that new AR reality product that the company unveiled just last week. So talking about how they are going to include it within that product and whether or not that could boost user engagement there as well. You look skeptical about that one.
No, I'm excited. I just want to hear, like, do you have good streaks with people on Snap?
No.
No? Oh, okay.
No, I just go on it from time to time, like here and there.
I sit next to you every day, all day. I
don't go on it daily. Yeah, no. But do you see me go on social media that much at my desk? I'm always working. I'm working hard, you know?
Yeah.
Outside of Twitter. Not enough time.
Crushing the character counts.
All right, guys, keep right here on Yahoo Finance. Coming up, Tesla poised for more upside as one analyst seeing the company topping deliveries expectations. We'll talk to the analyst behind that call next. Just about a minute here from the opening bell on Wall Street, taking a look at the futures action here. You've got the Dow futures pointing to gains at the open, as well as the NASDAQ 100 futures and the S&P 500 futures moving to the upside here. If we can flip over to the futures board here on the big board on the screen right now and take a look at the S&P 500 futures up nearly, hovering just shy of that 5,800 level. You got the NASDAQ 100 futures pushing to the upside. Taking a look at the 10-year Treasury, you got prices falling, you got yields moving to the upside here ahead of today's trading action. And coming off what was I guess not too much of an exciting day yesterday, but when you take a look inside the NASDAQ at some of those movers yesterday, you had a mixed picture when it comes to larger tech. You have Apple and Microsoft, Google all closing the day in the red. Nvidia, Amazon, and Meta closing up the day with gains. Flipping that over to the extended action, what we're seeing here in the pre-market, you're actually seeing a lot more green on your screen. You got Nvidia opening the day up just about 0.1%, and Apple adding just about 1% here at the open. So let's take a look at the major averages here as things do calibrate at the open. You've got the Dow pushing even higher today, just above the flat line. You got the S&P 500 now up just about 0.2%. This is Opening Bell. You're watching Morning Brief, brought to you by Invesco. Let's kick it over to Jared Blickery for a closer look at the market moves. Jared.
Thank you. I'm trying to get connected to the Wi-Fi Interactive, and here we go. Dow is up about 0.6%, a whopping 34 points there. S&P 500 up about 16 basis points, and the NASDAQ Composite up about 47. That's just about half a percentage point. Yesterday, the S&P 500 closed at a record high. Also want to check out the bond market because we're seeing a bit of action there. We've been talking about this China stimulus package, and I think that might be related. This is a year-to-date chart of the 10-year T-note yield. I'm going to dial this down to a 2-month chart, and we can see just a little bit of movement here, 6 basis points. But we are nevertheless up on a short-term basis, so we want to monitor these trends. U.S. dollar index is down, so sometimes the 10-year T-note yield and the dollar will move in the same direction, and not today. So maybe not the strength of the move that we were looking for. Bitcoin up about 63,000, but we want to get to our sector action right now. Let's see who's leading. And pre-market, we were looking at energy as a leader. It was up almost over 1%. It looks like it's up by 0.8% right now. Material sectors switching places with it for the first spot there. Utilities, real estate, those are the two worst sectors. Those are both interest rate sensitive, so not surprising to see that there. Then we have financial staples and healthcare. But something really interesting has been going on in the futures market that I want to highlight. I've been concerned about some of the deflation in the commodities market, but we have seen copper on a 10-day tear. Let me just show you over the last month what has happened in copper, up 6.7%. That's a lot for a commodity because people who trade in these things are highly leveraged. Here's the year-to-date chart, and we are definitely off of these highs right here. Here's where we are right now, but we are also materially off of these lows and these most recent lows right here. Here's that 10-day streak that we're looking at. Also seeing strength in the crude market, and this is key here. This is telling me we might be facing a little bit more inflation than we're thinking. Only yesterday I was talking about record bearish bets in crude, and I said, well, this just sets up the potential for a squeeze. Guess what we're getting today? We're getting a little bit of a squeeze here. Crude oil up 2.2%. I'm going to dial it back to the year-to-date chart, and you can see, yeah, we're still depressed. We're just in barely negative, positive territory here, but definitely off of the lows. And if you look at a 3-year chart, you're going to see that we are well within the lower end of the trading range. And I think in the near future, we might be talking about the upper end of the trading range, and that's going to be around $90 a barrel. So we'll have to see if that comes to pass, but something to think about.
All right, we're thinking about a lot this morning, Jared, including shares of Tesla. Thank you, Jared, for teeing this up as well here. Shares of Tesla trading at their highest level in 2 months. The stock barely higher this morning out of the gate. The stock may continue, though, to strengthen as third quarter deliveries are expected to top consensus estimates, according to Barclays. Joining us now is the analyst behind that call. We've got Dan Levy, who is the equal rating on the stock and a $220 price target. So let's dive into this. What is kind of behind the thesis right now for Tesla for you? I mean, I think just months back, we were talking about this being an AI company. We can explore whether it's still that or not, but what do you think is driving some of the momentum here for Tesla?
Great. Brad and Shauna, thank you so much for having me. Yeah, look, there's two streams that are driving Tesla stock. One is the fundamentals, and the other is the excitement over the AV AI narrative. I think if we looked to where Tesla was maybe 4 months ago, right around the time that they announced that they were going to pivot, and we saw weakness in fundamentals, there was pressure on the stock. I think since then, a couple of things have played out. First, you've seen stability on fundamentals, and you're going to see that likely with 3Q deliveries. Europe, US still sort of soft, but pretty good strength from China that have really driven stability in deliveries. And now we think that probably on track to be flat for the full year, as opposed to maybe they were tracking maybe down year over year a few months ago. The other thing is around the AV narrative. And of course, we have on October 10th, Robotaxi Day. Different ideas of what they'll talk about, but certainly this is the type of thing that will keep the narrative going.
So Dan, what does that tell us about margin improvement? Obviously, that's something that the street has been looking for, seeing any signs for the impact on margins. If they do see better deliveries, obviously I would think they would see an improvement, but I guess the question is, to the degree, how much?
Yeah, we do think there's going to be some modest margin improvement quarter over quarter. 2Q was a trough. You had obviously pretty weak volume. You also had pricing that was a drag, some warranty issues as well. We do think that improved volume will help. Pricing has been neutral, maybe slightly negative, but you do have tariffs coming online. So we're managing our expectations. They're still using pricing actions, but on an incremental basis versus where we were a quarter ago, maybe there hasn't been much more on the discounting side.
I mean, in terms of the catalyst from this point forward for Tesla, I mean, when we're thinking about what they've said and tried to pull levers around robotaxi or pulling levers around communicating themselves as an artificial intelligence company, how much runway is the street giving this company to prove that it can hit some of the lofty expectations that are getting priced into that valuation for them?
And that's part of the challenge. There is a valuation issue here, that I think is making some people uncomfortable. That's what underpins our equal weight rating. We think about things like autonomous, right, which is going to be the center of Robotaxi Day. There's a very long time frame of really truly monetizing the value of this. FSD, we think, is not really moving the needle a whole lot. And if we're talking about truly driverless ride sharing model, is going to take them a very long time to get that to scale and to be a proper business model. What could happen along the way, though, is we've fully seen that there is a narrative around this, right? And that's the piece that's somewhat unpredictable, is how the narrative plays out. But from a fundamental standpoint, in seeing these businesses play out, that's going to take some time.
In the face of continued weakness on the consumer front, or a battle-weary consumer, as Conference Board Chief Economist Dana Peterson has told us before, what does that spell out for what you were just mentioning in full self-driving and the add-on components that Tesla counts on for some of their purchasers in order to make sure that they can see more margins over time because of that subscription model to it?
Well, as much as it can help on the margin, the reality is, at its core, this is still a vehicle sales business, right? There are some enhancements, right? We are seeing actually energy is something that's gotten a lot of, that's helped in the last few quarters. You had a very good quarter out of energy in 2Q, and that's been margin accretive. That has helped. But at its core, this is still a vehicle sales, vehicle manufacturing business as it relates to the business today. And so that is going to be what determines the path of margins for at least the next few years, that alongside how much they're going to be investing on some of these AV efforts.
So Dan, we certainly have seen a rally in Tesla stock over the last couple of months at least. We're up almost 40% in the last 3 months alone. If they do beat on deliveries, how big of a catalyst do you see that being for shares?
It can help, right? And there's positioning into Robotaxi Day, so that can help. I think we're just going from event to event. That's the way that we would look at it.
Just quickly, Dan, while we have you, when does Tesla need to uncloak that one additional vehicle that we've been waiting for that right now just looks like Casper the Ghost with a sheet over top of it in so many of the materials that we see?
Well, actually, what we think is that they will show something at Robotaxi Day, right? If you go back to the 2Q earnings call, Elon said they'll show a couple other things, right? We suspect that what they'll do is they'll show a low-priced, a low-cost vehicle, and that's something that they've talked about is a 1H25 launch. Now, just remember, this is going to be made on the existing Model Y line in Austin, so it remains to be seen how truly differentiated it is. But we do expect that we think it's a possibility that you'll see that a prototype or a view of that vehicle at Robotaxi Day.
All right, Dan Levy, always great to get your insight. Thanks so much for hopping on with us here this morning. Dan Levy of Barclays, thank you. Well, coming up, U.S. stocks continuing the climb into record territory, but will the gains last? We will discuss next on Morning Brief.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
The U.S. economy remains strong. and core inflation remains uncomfortably above our 2% target. In light of these economic conditions, a few further considerations supported the case for a more measured approach in beginning the process to recalibrate our policy stance to remove restriction and to move to a more neutral stance.
That was Federal Reserve Governor Michelle Bowman delivering comments on the state of the economy this morning. She was the only Fed governor to cast a dissenting vote for a 50 basis point cut at the September meeting. That brings us to today's strategy session. Our next guest says that the Fed's outsized cut was the right thing to do, but markets are in a fragile place. Joining us now is Irene Tunkel, BCA Research Chief U.S. Equity Strategist. All right, how fragile are we talking here? Because you hear the comments from Fed Chair Michelle Bowman, who was the lone dissenting vote. So where exactly in the fragility kind of spectrum are you placing things?
Why did I say that? Well, I think that I would not say that we're in a recession. We are not in a recession right now. I think that the reason we say fragility and generally, have a slightly more, bearish tone to everything, we write is we do not like the trajectory of the U.S. economy. And what worries us the most is the direction of the job market. So it's not about the unemployment rate per se, but it's about some of the leading indicators of the job market, such as job openings, such as number of people working part-time for economic reasons. There is plenty of other ones. So basically, if you lose a job, it's a little harder to find a job. So I think the job market is now in the center of this discussion. And I would say that the reason that the Fed did 50 bips is because they were responding to the same concerns. So yes, economy is strong as of now. You may say that it is in a soft landing now. The problem is that soft landing is almost like a temporary state. And so to stay here would require lots of luck. I would say even more than skill.
So then does that mean that for the Fed's next decision, I would guess that you think it probably makes sense to go another 50 basis point cut in November?
Well, I think that when I say that it's skill versus luck, there's a lot in play here because inflation is above the target, just as Governor Bowman said. So I think that they need to balance the risk that they will reignite the economy and inflation will go up. And there are many sort of negative repercussions to that. First, they may have to reverse their easing cycle and have to raise rates again. That will have a very negative effect on the economy and the market. And also, this may push the treasury rates up. And that will more or less undo all this easing process. So they really are walking a tightrope. So it's really hard. And that's why it will require lots of skill. The instruments are too blunt.
And so with that in mind, I mean, are the instruments that they have going to be able to kind of walk that tightrope? And where in the other data points that the Fed should be evaluating, can they look for some sense of calm even when they are implementing policy?
Yeah, well, what do they have? They move the rates. They don't really feel the effect. They don't see the effects of the rates until they kind of go through the economy, which is 3 to 6 months. That's the main tool that they have. And so these long and variable lags make it very difficult. And the reason that I say skill versus luck, they may be very skillful. And I would say that so far they've been doing an amazing job. But to keep economy, where it is, keeping it in balance is a hugely difficult task. I would say that probably they did the right thing, but let's say they do another 50 bips. What if they overdo? Because they don't even know what is this neutral rate, where economy doesn't grow, doesn't contract. So basically, they are walking in the dark, sort of feeling their way.
So what does that mean investors should be doing? Should they be positioning more defensively? How should they then be approaching these uncertain next few months?
Yeah, it's a fair point. The market kind of keeps hitting the new highs every day, and you start to wonder, what is going on? And there was this amazing day on Thursday when the market just, surged. I think this is the initial reaction that we pretty much get at the beginning of every easing cycle. And after that, people kind of stop and pause like they do now and say, what does it really mean? Why did they go 50 bips? And it's not like the Fed knows something we do not know. We all look at the same data. But I think that 50 bip cut underlined their concerns about, the employment side of their dual mandate. And if that is so they are not just normalizing, which they do, but it's not only that, because otherwise they would be much, more careful moving. They made a big step. So there are underlying concerns about the economy. If there are underlying concerns about the economy, it means that the economy is actually getting worse, and investors should position defensively. And if you saw what was working in the run-up to this cut was defensive, actually.
We often hear defensively, and it's kind of a broad stroke on some very specific parameters that investors should be looking at. What are the characteristics of the defensive trade?
Well, if I am to be very technical, I would say low beta, so something that makes portfolio less volatile, less responsive to the market moves. But in practical terms, what is defensive? These are sectors and companies who have very stable earnings stream. Utilities, you always need utilities. Telecoms, no one can live without their phones these days. Healthcare, no matter what, you will have to get your treatment. And consumer staples, parts of it are a little bit, I would say, maybe a little bit more exposed to, slowing economy, but generally you gotta buy your staples. And that means that even in a recession, they will be generating earnings growth. Perhaps not very exciting. They never do.
Steady.
They try, though.
So, yeah.
They try.
All right, Irene, thanks so much for joining us here.
My pleasure.
On Set today.
Thank you.
Well, it's time now to get to our chart of the day. If you thought NVIDIA was the best performing stock on the S&P 500, well, think again. The company now surpassed by Vistra Energy as investors look beyond AI hardware and invest in the infrastructure of powering it. Catalyst co-host Madison Mills joining us now with more. Hey, Maddie.
Hey, Shauna. So take a look at this board behind me. NVIDIA is no longer the king, at least for the S&P 500 here. You've got NVIDIA up over 136% year to date. As of the close yesterday, not a bad run for them, right? But then you've got Vistra really coming up here, especially since the market rout back in August, having a huge run over the past 2 months and really surpassing NVIDIA up over 195% year to date. And you mentioned this, Shauna, but just to give a little bit more context here, this is a nuclear power play. We've spoken with a lot of analysts across our hours here at Yahoo Finance about the importance of these plays, as yes, you have the chips names like NVIDIA, the data centers buying a lot of chips from those companies, but this is kind of that third level picks and shovels play that investors know and love with Vistra, because the data centers require so much energy. That is going to be a positive catalyst for a lot of these nuclear power players like a Vistra. Their peer in the space is Constellation Energy, which recently went into partnership with Microsoft. We saw a huge rally in that stock after that news. So analysts expecting more of this to come. I also want to point out a price target raise from Jefferies on Vistra this morning from $99 to $137. Vistra is their top pick in the power space, so even above the other peer in the space, Constellation Energy. They are picking Vistra up over that. Having said that, there is still optimism for NVIDIA in the space. Melius Research talking about how the ROI fog needs to calm down and we need to avoid a recession. If we're able to do those two things, there's still some good news to come for NVIDIA, guys.
All right, nice chart. Maddie, thanks so much. Appreciate it. Guys, coming up, some top trending tickers from Yahoo Finance's homepage. That's next. You're watching Morning Brief, brought to you by Invesco this morning. We're taking a closer look at Yahoo Finance's trending tickers. 3 names to watch here. We've got Snowflake, Starbucks, and DJT. And we're doing it, or we're going to try to, in 30 seconds or less each. Let's go. First up, Snowflake outlining plans to raise $2 billion in debt. What they're trying to do here is actually finance a $575 million share buyback plan, as well as acquisitions and investments. Shares right now are down by about 1.3% for anybody that's been tracking this company over the course of the year. One of the things that you'll remember is that the year run-up has included a lot of the scrutiny around some of the deal cycles right now, and so that has certainly played out. But year-to-date, down by about 41%. A lot of room to prove to investors that it can do something solid here. With this buyback plan.
All right, let's move it on to Starbucks getting a downgrade from Jefferies, cutting the stock to underperform from hold, saying that the rally over the coffee chain's new CEO is overdone. Now, this stock is actually up more than 20%, 24% since Brian Niccol was named CEO of Starbucks. So, Indy Barish, analyst there at Jefferies, making the case that maybe this is overdone, saying that the turnaround is not a straightforward one. It's going to take time. He's saying that while the new CEO suggests necessary strategic change is now on the table, we believe execution is going to be challenged.
Nice job. All right, and finally here, DJT sliding today after plunging more than 10% yesterday. The 6-month lockup period to prevent early investors from selling or transferring shares ended on Thursday. The public finds out today if any sales took place on Friday. Now, I know what you're thinking. I said it was sliding today. It's up by about 2%, but it slid earlier. It actually hit a new, fresh, all-time low since the de-SPAC has taken place. So ultimately here, we'll see if this is a dead cat bounce or if there's more sliding to come.
I'm going to go off the ladder.
Dead cat?
We'll see. No, the more sliding to come.
Oh, okay, gotcha.
All right, coming up, we're getting a fresh read on the consumer at the top of the 10 a.m. hour. We're going to dive into that next on Catalyst. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. 30 minutes into the trading day, we've got three catalysts moving the markets this morning. Consumer confidence out at the top of the hour, a potential strike at the largest port on the East Coast, and another threat, a tariff threat from former President Trump.
Consumer confidence showing Americans are feeling ever so slightly better than expected about the economy, actually worse than expected about the economy, coming in just below expectations. We're going to break those numbers for you in just a minute, but this comes after the Fed's larger than expected rate cut. Fed Governor Michelle Bowman expressing why she was the lone dissenting voice for the central bank this morning.
I was concerned that reducing the target range for the federal funds rate by 50 basis points could be interpreted as a signal that the committee sees some fragility or greater downside risks to the economy.
We'll discuss how consumer sentiment could affect the Fed's path forward.
And the largest port on the East Coast is preparing for its first strike since 1977. 45,000 workers could walk out on October 1st if no deal is reached. We'll discuss whether or not a strike could reignite inflation.
And former President Donald Trump vowing more tariffs to come, threatening John Deere a 200% tariff if production moves to Mexico for the company. Trump is expected to speak about his economic agenda later today. We'll discuss how companies are responding to these potential policy changes.
All right, first we want to get to some breaking news. We have fresh data out on the consumer confidence coming in below expectations. We're seeing a bit of a reaction play out in the markets here right now, but taking a look at that headline number, U.S. September consumer confidence reading coming in below that 100 level at 98.7. The estimate was for the index to come in at 104. As a result, we are seeing all three of the major averages turn negative. You've got the Dow just below the flat line. You've now got the NASDAQ 100 off about 0.2%, as well as the S&P 500. And Maddie, when you take a look at the market's reaction to this, clearly the concern here for investors, for the market, is what ultimately this means in terms of the strength of the overall economy. If we are seeing a weakening consumer, maybe what risks this then poses to economic growth down the line.
Yeah, it's interesting given especially just the degree of downward pressure that we saw in this number with the expectation of 104, a significant miss here. And this is kind of what the market was afraid of, right? The idea that the Fed cut a little too much too soon. This is exactly what Governor Bowman talked about in her speech this morning, just an hour ago, feeling very prescient coming into a number like this. The idea that there was potentially some sickness out there in the economy that the Fed was signaling by going 50 as opposed to starting by 25. Having said that, there does continue to be a little bit of a dissonance between what the Fed thinks about the economy versus what consumers think, and maybe this is just a continuation of that. Having said that, we are going to get to some sound from Governor Bowman. Here's what she spoke about this morning in terms of why she preferred a 25 basis point cut.
I was also concerned that reducing the policy rate by half a point could have led market participants to expect that the committee would lower the target range by that same pace at future meetings until the policy rate approaches a neutral level. If this expectation had materialized, we could have seen an unwarranted decline in longer-term interest rates, and broader financial conditions could become overly accommodative.
For more on how the market is poised to react to this data here, we're going to bring in Brian Levitt. He's the global market strategist over at Invesco. Brian, I got to get your reaction to this data and the market flipping on the heels of it. Is it an overreaction?
It doesn't look like the market is overreacting too much, which is a good thing. Look, we needed to slow the consumer down. I mean, that's where we were a couple of years ago when inflation was so hot, and the Federal Reserve took the steps to do it. At some point, you have to be careful what you wish for, and so this is an economy that is slowing. Leading indicators are pointing to further slowdown, and that's why we're starting to get the policy accommodations.
So, Brian, what do you think the Fed will likely do at the next meeting, right? We're starting to get the policy accommodations. Of course, the market looking for another 50 basis point cut at the next meeting. How likely do you think that is?
I think there's a reasonable probability of it. I'm not too overly concerned, Shauna, about each of the meetings. My perspective is on where are we heading to just to get to a neutral rate. And it seems based on the growth and inflation potential of this country over the next few years, that neutral rate should be more in the threes rather than where we are now. And if things roll over more, then the terminal rate could be lower than that. So Whether it's 25 or 50 at the next, I think the larger message to investors is that we've got a lot of rate cuts coming. And it's, in essence, a race between the Federal Reserve to lower rates and reinvigorate activity. And what we've seen more recently is a pickup in the unemployment rate and which one wins out.
Which of those do you think is going to win out, Brian?
I'm still in the soft landing camp, and the reason I'm still in the soft landing camp is because there's not a lot of leverage and excess in this economy, which there typically is before a recession. And the key indicators that typically signal a recession, I'd say there's three of them. One is the inversion and then normalization of the yield curve. Yeah, that one's signaling risk, but the other two, corporate borrowing costs relative to the risk-free rate, very benign, and the bankers don't seem to be tightening lending standards. So I would still categorize it as a soft landing, but the risks to growth are elevated. This is no longer a concern about inflation. That is passé. This is a growth story, and the Federal Reserve is responding accordingly.
Brian, we've seen a bit of a run-up here in defensive sectors over the last couple of weeks, given the fact that we do have this risk here, or I guess maybe confidence. Risk of recession obviously is adding to that defense play, right? But when you talk about the fact that maybe we are having growing confidence that we are going to be able to orchestrate this soft landing, is that outperformance that we've seen most recently, do you think that's likely to fade?
You probably need more clarity on the soft landing. So our tactical indicator right now is a bit more defensive. It's focusing more on the deterioration of growth. Now, if the Federal Reserve gets more aggressive here and the soft landing becomes even more viable, then yeah, you want to shift to what we would categorize as more of a recovery trade in the portfolio, which tends to favor risky credit, but within the equity sector, within equities also favors cyclicals, value, small cap. So it may be a little bit too early given the uncertainty that still exists, but if you're looking out over the next few years, yeah, the recovery trade should be the one to favor.
Brian, I want to talk about some information we learned from former President Trump last night, speaking about potential tariffs against John Deere. Take a listen to this soundbite, and then we'll get your reaction.
I just noticed behind me John Deere tractors. I know a lot about John Deere. I love the company. But as you know, they've announced a few days ago that they're going to move a lot of their manufacturing business to Mexico. I'm just notifying John Deere right now. If you do that, we're putting a 200% tariff on everything that you want to sell into the United States.
How do you think that potential policy moves, like the one that former President Trump mentioned in that clip, are playing into any sort of company-level activity ahead of the election? And could that potentially play into the broader economy here?
The challenge with tariffs is not necessarily the tariff rate, it's really more the uncertainty around it. So if you think back to 2018 and 19, business investment froze because we did not know what the tariff rates were going to be. And then once the ink dried, things started to get better. Of course, we then hit a pandemic. So the concern here is around the uncertainty and will business investment slow? Will hiring slow until we have greater clarity on this? I think that's likely. So it still points to the risk being towards growth. Some people hear tariffs and immediately go to inflation. My mind goes to business confidence, business investment, and what that means for growth. It probably portends, if that's the case, more rate cuts. So I'm not overly concerned about tariffs when it comes to the broad economy over the intermediate term time period. Businesses adjust, currency markets adjust. Rather, what I'm concerned about is any extended period of uncertainty. Now, election's in 6 weeks, so let's see where this goes.
Well, Brian, when we talk about the fact that there's uncertainty surrounding the election, there's uncertainty surrounding geopolitical relations right now. But when you talk about that rising geopolitical risk, how much of that has been factored into the market? And if not, I guess, how big of a driver do you see that being for sentiment here over the next couple of months?
Russia went into Ukraine in 2022, and the Middle East conflict started on October 7th of 2023, and the market, as of a few minutes ago, was at an all-time high. So far, the market has largely been looking beyond it. And really, when I was taught about strategy, I was taught to answer three questions. Where are we in the cycle? What's the direction of the economy? What's the Fed going to do? And the only way geopolitical conflict or presidential elections enter into it is if you think it's going to change the answer answer to any or all of those three questions. And so thus far, particularly given the amount of oil production in this country, thus far, conflict has not changed the answers to those questions. We're still, a bit late in the cycle. The economy's slowing and the Fed's accommodative. And that would have been the case irrespective of these two horrifying events that we're all watching.
All right, Brian Levitt, great perspective there. Invesco's global market strategist. Thanks so much for hopping on with us here this morning.
My pleasure.
Well, coming up, we're taking a deep dive into the small cap trade and the stocks that are best positioned to outperform in a lower rate environment. We've got that for you next on Catalysts. Small cap stocks on the move slightly higher here, up just about 0.3% over the last 5 days. You're looking at gains of about 1% for the Russell 2000 index. Now, this moved this morning following some of those gains that we've seen in recent weeks, especially after last week's Fed rate cut. And as the Fed continues its easing cycle, many investors are betting that small caps could go even higher. So let's talk about that with Greg Tordo. He's a Goldman Sachs Asset Management Portfolio Manager. Greg, it's great to have you back here on set with us. So talk to us about this optimism right now sweeping Wall Street when it comes to some of that upside here for small caps. What do you think that upside looks like?
Yeah, I think it's there's been a number of tailwinds for small caps that really have been ignored over the last couple of years as we've waited for this rate uncertainty. The economy is quite stable. It's still growing. I don't think that we're expecting a big downtick in the economy next year. That's good. It's a very domestic asset class, and the U.S. is the best house in a number of bad neighborhoods. That's also quite good. And if you look at some of the areas, some of the industries around, whether it's technology, healthcare, parts of the consumer, even despite the consumer confidence number, there are a lot of places where you can find some really interesting, kind of undervalued names out there. Even today, and small caps have been up, kind of in low double digits, mid double digits year to date.
How long does your time horizon have to be to really see a positive return on small caps? Does it have to be a couple of years, or is there near-term gains as well?
Well, this is a pretty unique cycle. Small caps have underperformed for almost 3 years since Powell was reappointed back in November of 2021. So you usually don't have these large, kind of down cycles for small caps. So usually you'd say about a year is normal. I think this year is it's different this time. Can't believe I said that, but I do think that there's a lot of pent up opportunity in this space, because what you've seen in terms of small cap performance has not come from multiple expansion. It's really come from the earnings, and we think that the earnings opportunity next year for small caps is better than it was in 2024. We think it's better than large caps. And I think if you put those two things together, a year from now, you could have a pretty significant absolute, and we think relative return over large caps that you'd be pretty happy with.
What are your expectations for rate cuts, right? When we talk about the fact that the Fed has pivoted now, it's starting to ease a lot of that. I guess there's some wavering amount of confidence right now about whether or not the Fed's going to be able to orchestrate or pull off a soft landing. How many rate cuts do you have baked into your expectations at this point?
So I don't get that deep into the amount of rate cuts, but I do think that they will cut at both meetings. I think that we'll probably see another, kind of chance that we could get close to 50 again in one of those two meetings. But I do think that we have to stop thinking about 50 as such a signal. It wasn't as much of a signal on the way up. After a while, we got used to 50, and I think that some people think that that's more of a weapon. It's a tool, right? And if you think about that, and that's the way they used it on the way up, so I think they'll use it that way on the way down too.
Why aren't you watching the amount of rate cuts too closely?
Because I do think that so many of our companies, had to really understand how to operate under much higher rates. So I think that as you kind of think about where things are going, it's much more of a significantly more powerful tailwind than a normal rate cut cycle. So if you think about what that meant to their earnings, it wasn't as much of a suppression to earnings. So we think that there's a bit more of a delinking in terms of what's happening at the company level than in what's happening, kind of in the economic level. And if you think about, the market's going to be high twos, close to 3% GDP growth this quarter. I think for 2025. Most of the estimates and forecasts are, 2.5. That's a pretty good place to invest for small caps, because I think that gives you that benign tailwind that these companies can, if they're in good places to be, they can work pretty well.
To that end, I want to get into some of your picks before we let you go. You have a couple of software names that you like, which is interesting to me. Are any of these software names that you have here AI-related plays, or what's the thesis?
Yeah, I think software has been a place to avoid when rates were higher, and I think now that rates are lower, it's an interesting tactical time to get back in there. You're going to see some IPOs in software. You saw one earlier this year. You'll see more in the back half of the year. We actually even saw some software M&A today, which is also a good sign for multiples. DigitalOcean is one of our picks. We do think that there's a large AI opportunity, especially in the SMB, the small medium business, to take advantage there. So I think that that's an area that we like a lot. Alchemy Technologies is another one. It's a little bit less direct. I think what happens in the guts of their operating system, which helps banks service their customers, that has some AI technology in it. But DigitalOcean is a little bit more specifically geared towards kind of the AI side of things and helping small businesses operate.
You also have some picks in the healthcare space and consumer, but I want to focus on consumer. We only have about a minute left here. Where are you seeing the opportunity there, and what should investors be screening for?
Yeah, I think that we saw a lot of strength in restaurants earlier this year. I think retailers were left out of the party. We like some of these, kind of uniquely idiosyncratic retailers like an Ollie's or a Boot Barn. I think that there's an opportunity for Ollie's that's structural, in terms of one of their largest competitors is going out of business. And on Boot Barn, beyond the Western wear theme of Beyonce and the return of Yellowstone in November, I do think that this is a really, really well-run company with some significant store expansion ahead of it. And in that sense, you're growing very profitably. And I think that that's something that you don't find in a lot of small retailers.
You helped us squeeze the Beyonce news with her and Levi's into our show today, so I really appreciate that. Thank you so much for joining us. Thanks for coming in studio.
Thanks for having me.
Appreciate it. Moving on here, U.S. listed Chinese stocks advancing today after China's CSI 300 index seen its best day since 2020. That move comes after Chinese officials announced a slew of economic stimulus policies, including lower borrowing costs and more stimulus. Could the moves be enough to shore up China's economy after a tough period? For more on that, we're going to bring in Jeffrey Kleintop. He is the Chief Global Investment Strategist over at Charles Schwab. And Jeffrey, it's great to have you here. How do you read these policy proposals from Beijing? Is this really going to move the needle?
The jury's out. I think the Fed paved the way for more stimulus from the People's Bank of China to cut rates without worrying about the currency today. And this wide range of measures, you've got multiple agencies involved, and a rare live press conference with a Q&A session indicates a sense of urgency by China to support the economy. But a lower mortgage rate on existing loans might help households, but it doesn't do anything to arrest the decline in property prices or aggregate incomes or jobs. As a result, it's a positive, but it's unclear how long-lasting of an impact this will have on stocks. President Xi, in my opinion, is not likely pivoting to support for housing and consumers away from support for industry and self-sufficiency, which he views as a security imperative.
So then, Jeffrey, is it safe to say that maybe this massive rally that we did see today on the heels of this news, it's a bit of an overreaction to the upside?
Yeah, I'm afraid we might already know how this is going to end for China. We know that Chinese stocks have rallied 20% in the past when hopes about a stimulus-driven turnaround happened. We saw that in May of this year, but that rally fizzled out as details revealed that the plan just wasn't as big or broad as hoped as it was actually implemented, and funding sources were pretty scarce. So only time will tell, but repeated attempts in recent years have not led to lasting gains. Now, of course, a potential 20% market rally could boost China's consumer sentiment in the near term, but that might be offset by the continued weight of the property market on confidence.
Yeah, I mean, that's my question, is what's going to really move the needle, and what will the Chinese economy look like a year from today? Jeffrey, I spoke with an analyst yesterday who is confident that at some point it has to turn around. This is supposed to be the world's biggest economy, but should we be so confident that this story is going to turn around?
No, I don't think this is a sign that the consumer is getting the support that the consumer needs. Remember, the consumer is now the biggest portion of China's economy, but all the stimulus lately has been directed towards self-sufficiency in semiconductors, in green technology, in areas where China is being cut off by the rest of the world. And so while there is some manufacturing output growth within China, all that increase in supply isn't being matched by any demand from consumers or businesses within China. So you're seeing deflation and just a negative spiral there in terms of economic activity. Sure, China's stocks are up, 4% today, 4.3% today, adding to the gains over the past couple of weeks as they bounce off of a forward PE that's below 9. We're looking at extremely cheap stocks in hopes that more stimulus is going to be coming. And you even saw French stocks up 1% today as investors factor in better, maybe luxury good demand from Chinese consumers. But I'm not convinced that's going to happen. I think the Chinese consumer is going to remain weak even a year from now.
So then, Jeffrey, investors that are trying to figure out what they should be doing, if they have exposure to China right now, they've been thinking about it. It sounds like it's going to take quite some time in order to really gain any sort of sustainable momentum. So how should they be approaching the region?
Well, I think if you're focused purely on China, the stocks are very cheap, and any kind of news like this can get them to bounce. I don't know that it's a sustainable bounce, but we've probably put in the lows we're likely to see for China stocks this cycle. That said, there may not be additional upward momentum, as we look at the economic picture over the next year. What I would say is looking at the bigger picture, this move today is a reminder that we're in a global easing cycle. Most central banks are cutting, and now some doing so aggressively, easing global financial conditions. And that's likely to boost cyclical stocks, more prevalent in international indices and emerging market indexes, even outside of China, than the secular growth stocks that have been driving the U.S. stock market to outperform in the first half of this year.
And I guess I'm curious, too, to that end, you mentioned kind of the macro impact of central bank easing, but also then the equity-specific impact on names like luxury stocks, for example. Does the China deflationary story impact equities more, or is it more of a macro challenge that U.S.-based consumers even should be thinking about because of the economic impact? Which is worse, I guess, economy or markets?
Certainly we can't discount China. There's so much of a U.S. focus on some of the tech names and the election, but China is the second largest economy in the world, and its impact on supply is definitely having a deflationary impact. That said, it's offset by other potential factors. We've got potential strike here in terms of supply chains in ports. That could be an issue coming up here. So there's a variety of inflationary, deflationary, and inflationary factors that are going to create some volatility and maybe some questions about the path for the Fed, which the market's very confident about over the next year or so. So all of this backs into a picture where there could be some volatility in the overall economic backdrop. I like what I'm seeing, not in defensives, but in cyclicals, particularly those outside the U.S., in Europe and other areas, not as touched by the China slowdown.
And Jeffrey, real quick, as we wrap this up and going back to focusing specifically on China, just given the magnitude of today's move, I guess how cautious do you think investors need to be, just given the dramatic shifts that we could see and that we likely do see in China when it comes to policy?
China's policy moves are opaque, and this is the biggest problem. Most other countries around the world, you get a sense of where they're going, or the central bank attempts to talk the market into a direction before it makes a move. And that's just not true in China. That creates a lot of potential for volatility, especially when you see these dramatic moves now, and increasingly dramatic moves. I don't think this is the last we're going to hear from China in terms of stimulus, not from the People's Bank of China or on the fiscal stimulus side. So expect more to come here in the near term, and that can, of course, create some volatility.
All right, Jeffrey Kleintop, great to get your insight here this morning, given the news of the day. Charles Schwab, Chief Global Investment Strategist. Thanks, Jeffrey. Coming up, we're going to take a look at some of today's top trending stocks on Yahoo Finance. We'll give you the news behind the moves in luxury and weight loss drug stocks. Quite the pairing. That's coming up next on Catalyst.
Let's get to some of our trending tickers for today. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Now, taking a look at luxury European stocks boosted by China's stimulus package, investors betting it will revive Chinese demand for luxury goods. And you can see a basket of European luxury stocks moving to the upside on your screen. I also wanted to point out this led the MSCI, the global stocks index, to its highest high of all time this morning. We also saw the CAC 40 index over in France moving to the upside. And France in particular is heavily weighted towards those luxury names. So it made sense to see that degree of upward movement. You can see that on your screen right there, heavily in the green. I took a look real quick, Shauna, at LVMH in particular. 40% of their revenue last year came from APAC alone in 2023, and they certainly cited that in their latest earnings print as a headwind that was impacting their revenue. So the China growth story and the potential of that story, Jeffrey Kleintop thrown a little bit of water on that with us a couple minutes ago, but could be a big boon.
Yeah, exactly. And this could potentially be a boost here, a further boost to these stocks in the near term. We heard from Imrez last quarter, and they were saying that the spending slowdown that they had been seeing in China was a huge headwind and a challenge to their business, and one that was likely to stick around here in the coming months, and that has turned out to likely to be true. So now that we are seeing this stimulus package play out in China, some of that optimism sweeping across not only Chinese markets, but obviously spilling over into some of the, especially the spillover effect into the luxury goods sector. I think you got to question what the staying power is, right? And we were just talking to Jeffrey Kleintop a few moments ago, and he was saying that he is actually not convinced that this is really going to be enough to turn around China's lagging economy right now. Yes, there is a lot of optimism that this is a step in the right direction, but when you take a look at the fundamentals and take a look underneath the hood there is a tremendous amount of weakness within China's economy. So again, this is a bet that the stimulus efforts is then going to trickle down through into the Chinese consumer, get them a bit more confidence or help their confidence, and then further boost spending on higher end, on luxury goods. So whether or not that actually comes to fruition is very much still up for debate at this point, but at least the street's first read and first reaction to this is that they are optimistic that we could see some follow through here in the coming months, but time will tell.
Time will tell. Certainly a story that has not gone away over the last couple of years. But we want to get to another story we are looking at here. Novo Nordisk's CEO testifying at a Senate hearing on the price of weight loss drugs. Here with more, we've got Yahoo Finance's Anjali Kemlani. Anj, great to have you on set with us to discuss this. So how much can we expect to really come out of this Senate hearing today? I know that it can often be a lot of sound bites back and forth, but what are you monitoring?
Yeah, well, I'm looking specifically for, and just as a note, Lars Jorgensen, the CEO of Novo Nordisk, just started speaking. We've heard from the senators before this, and they've been looking at what they can get as sort of a commitment out of the CEO in terms of lowering prices. But Senator Bernie Sanders starting off by saying that he's gotten a commitment from the PBMs that if Novo Nordisk lowers prices, then they will increase access, especially for Wegovy, the weight loss drug. And that's really the crux of the issue, because we know the diabetes drugs are covered and they have been. There's no rules against it. But we also know that the weight loss drugs are the ones that are less favorable in price-wise, even though we've seen some moves for reduction. For example, Eli Lilly just reducing the starter doses through Lilly Direct for those paying cash. So there have been ups and downs and movement on this. There has been a little bit more competition sort of working up, but it seems like the crux of the issue is that we are still paying more than other countries. If you take a look at what the US is paying versus, say, the UK, which is down to $92 per month versus the nearly $1,000 right here in the US. Meanwhile, Bernie Sanders also noted that what the companies are doing isn't necessarily illegal, right? And so there is no issue in which they could force this, but he has spoken to generic manufacturers that could say that this can be produced at about $100 a month. There have been studies that look at maybe $5 a month, as low as that. So there's a lot of discussion over what the actual cost of producing this and how much Novo Nordisk needs to get back for its investment in manufacturing, research, et cetera. So listen to what Senator Sanders had to say just a moment ago. He basically talked about, the fact that it isn't illegal, the fact that the president and he have written an op-ed that has looked at the pricing and whether or not they have a way to force the generic version to come out. Now, we do know that Ozempic, for example, the patents for it have started to come off. A few of the patents are actually already expired, but the main one is not going to come off until 2031. So that's the first year that we could see generic competition if the U.S. government doesn't try to intervene or try to force something else. So that's what I'm going to listen to is, what does Novo Nordisk have to say about that? Are they trying to commit to lowering? We know that Lilly has been more sort of out the door in terms of increasing competition. So what are they going to say? Are they going to stick to their guns and say, you know what, we're a different company, we operate differently, we're not American, we have a different corporate structure, we're not as greedy, et cetera, et cetera. Mm-hmm. So that's sort of been the crux of what Novo has been trying to emphasize.
Interesting to get any insight there. Anj, thanks so much for breaking that down. We look forward for your coverage here at Yahoo Finance. Well, bullish calls sweeping Wall Street, and some strategists, well, they actually expect the S&P 500 to keep climbing higher, reaching and maybe even surpassing 6,000 by the end of the year. Yahoo Finance's Josh Schaefer is here now with a closer look. Josh, you did a deep dive into this for Yahoo Finance's morning brief. Anyone out there should subscribe if they don't currently. But Josh, what is your takeaway from this bullish narrative that seems to be gaining some steam?
Yeah, I mean, my biggest takeaway was we had talked about S&P 6,000 going back to February. There were people that were making this their bull case, meaning it wasn't their base case, but it was their most optimistic outlook. Barclays was one of those firms saying that. Capital Economics had said S&P 6,000 by the end of the year. But those cases were all built in this AI bubble narrative. It was, okay, we're going to continue to have, if we continue to have mega cap exceptionalism, meaning those Mag 7 keep rising, and there continues to be this AI euphoria, we can basically build a bubble that gets you to 6,000. I think that also caught a lot of people's eyes as maybe concerning. That would be what brings us to S&P 6,000. But when you go back to BMO Capital Markets, Brian Belsky's upgrade last week when he called for 6,100, he didn't talk a lot about AI. Yeah. He actually barely mentioned the Fed. He really talked about the shifts that we've seen in the S&P 493, he uses the S&P 490. He had an interesting chart in there about what we've seen this quarter thus far for the 490 stocks versus the top 10. It's the first quarter we've seen those 490 outperforming the top 10 going back in about over a 2-year period. And that just stuck out to me as, okay, this is a little bit of a different narrative that gets us to 6,000, and one, quite frankly, that as an investor, I believe in a little bit more, and maybe I feel a little bit more comfortable with if that's what is bringing us higher.
And I'm curious in terms of the market action we're seeing today, right? Markets flipping on the heels of that consumer sentiment data. It makes me wonder how much conviction your sources have in these bullish calls, given that the market can kind of turn on a dime depending on which data print.
I think the one thing that every strategist, or it seems like every strategist is pointing out right now, is how thin of a line we're on. Because what another part of this case right now is the perfect soft landing, right? It is the ideal soft landing. It's the Fed can cut by 50, tell us it's good, the market believes it's good, and we can rally. So that means your jobs reports need to not come in worse, right? Your inflation reports still need to keep coming in better. You need not a big drawdown from the election. I think to get that extra, it's only 5% at this point, but you'd be up over 25% on the year. I think to get that, you kind of need things to play out rather perfectly for the rest of the year. And I think that's a fine point that people are making too. I also quoted Lori Calvasino from RBC Capital Markets in that piece. And she said there's clear upside risk to her target at 5,700, which is about where we are, right? The risks are the economic data from here comes in absolutely perfect for a soft landing. So it's certainly a chance, but it feels like we are on a very, very thin line for us to not have risks here. And one of those will probably be next Friday with the first jobs report.
You know, Josh, it's so interesting because just talking about how the narrative has certainly shifted since the start of the year. We talk a lot about the fact that obviously when we talk about the rotation that's taken place, it seems like some, like you said, with Belsky, for example, though I feel like he's been saying this for a while, doesn't place as much emphasis maybe on Fed policy or doesn't like to talk about it or reference it as much in his notes as maybe some of the other strategists out there. I'm curious from your perspective and the strategists that you have been talking to, how closely are they, how much does it matter in terms of the degree of cuts between now and year end and even looking ahead to 2025? And I bring that up because we just had Greg Toro and he does small caps over at Goldman Sachs, and he was saying he actually doesn't really watch it at all. It doesn't really matter. It doesn't really factor into the narrative that they're closely tracking. So is that something that you're starting to notice?
I think Nick Colas over at DataTrack made a good point about the Fed is in easing mode. So that opens the door, right? Now that they have cut, that gives you the easing we've been talking about forever is actually coming. When you get into the nuanced argument of so we're already down 50, right? 75 versus 100 matter.
Right.
I haven't talked to anyone yet that's really making that argument that that's going to make that big of a difference. I think it's more that we're heading lower because also, Shauna, think about why would the Fed not cut the 100 basis points that the market's pricing right now? Not to talk in a circle here, but it's because the economy is doing well, right? So it sort of feeds back into that whole loop there. Perhaps the most concerning thing people would flag would be if the Fed does cut more than the market currently expects, because then you're probably getting signs of economic weakness. That seems to be how they're thinking about the Fed, at least at this point.
And to Greg's point too, they went up by 75 at certain points. If they go down by 75, whatever.
Yeah.
That was my take on the Goldman Sachs.
It was. You summed it up perfectly.
Yeah. Josh, thank you so much. Really appreciate it. Thank you. Well, coming up, workers across the East and Gulf Coast ports could go on strike as early as next week. We'll tell you which sectors could be most affected when we come back. The International Longshoremen's Union, which represents about 45,000 workers at ports across the East and Gulf Coasts, is set to strike next week. That's if they can't come to a deal by the September 30th deadline. To discuss what impact a prolonged strike could have on the country's supply chains and the broader economy, we've got Jason Miller. He's a supply chain management professor over at Michigan State University. Jason, thanks for being here. I want to just jump into the potential impact that this could have, right? To what extent, and you know, for viewers listening who maybe are not familiar with the supply chain challenges and economic impact of a strike like this, talk to me about kind of the degree of the potential impact of this.
Yeah, the degree of impact really is going to be a function of how long a potential strike takes place. If we're looking at 24, 48 hours, it wouldn't be that disruptive on the big scale of things. And again, that's always taking everything back, thinking about the type of disruptions we saw in 2021 and 2022. On the other hand, you start getting into a week or more, you're going to have an extensive pileup, and you can think about this as each additional day at that point, it's exponentially longer to unwind the situation. So a few day strike, not that bad, but an extended strike will be very disruptive, especially for importers in certain sectors.
Jason, how likely do you think that is?
Certainly at this point right now, given both sides are not talking and they're very far off in terms of wages, in terms of discussion of automation, it seems likely that we will have a strike at this point. So my base case right now is there will be a strike. It's really a question of how long will that take place once it would begin.
What's your base case for the longevity of the strike and just the degree to which they do kind of have bargaining power given the degree of impact?
Yeah, so right now, my base case would be we would get a couple days in, and I find it difficult to believe that the Biden administration will not invoke the Taft-Hartley Act and essentially have a commission form, deliver a report, and at that point, there'll be an 80-day cooling off period. We would expect some slowdowns over that period because the workers may not be working quite as fast. But it's very difficult for me to see how this plays out, let's say a 2-week extended strike, given the amount of disruption that would take place.
So then given the fact that maybe it's not going to take that long, but let's play devil's advocate. Let's say that this strike actually happens. It does last for 1 or 2 weeks. Inflationary pressures that we could see as a result, economic impact, GDP hit that we could see as a result of a prolonged strike. I guess more accurately, Jason, what does that look like?
Yeah, so from an inflationary standpoint, I'm not very worried about that. When you look right now at the piece of the CPI that's still the biggest driver of year-over-year inflation, it's that shelter component. And we know that's coming down because of the trend of a new tenant rent index that's produced by the Bureau of Labor Statistics. Where we do start to see more of an impact, though, is in certain industrial sectors. So on the export side, by far the most affected commodity is plastic resins. So we're going to start seeing, reduced exports because right now, year to date, we've shipped over 6 million metric tons of resin out of the U.S. in containers out of the East and Gulf Coast ports. On the import side, the most affected sector that I see is the auto space. Just given the key role that auto parts play as an import, this is especially the case for the German automakers. Their plants are in the U.S. South. There's really no opportunity to reroute those imports. And also the South Korean automakers, the majority of the auto parts imports from South Korea come into the U.S. through the East and Gulf Coast ports, going to Alabama and Georgia as a final destination.
And Jason, I want to get your take on something I heard from Chris Versace. He's Tematica Research's chief investment officer. He was on our show yesterday and discussed the potential impact the strike could have on inflation and therefore future potential rate cuts from the Fed. Would love to get your reaction on the other side here.
We also have this upcoming longshoreman strike that could be, really crippling to supply chains, particularly on the East Coast and the Gulf Coast ports. Could also kind of, tick inflation back up. And if that happens, then we have to re-question what the Fed may do between now and the end of the year.
So, Jason, do you think that the potential inflationary pressures from this are going to be as widespread as Chris mentioned there? Or do you think it'll be a little bit more contained to certain, products or sectors?
Yeah, I certainly view it as much more contained because, again, you always have to look and say roughly 10% of consumer spending of all types comes from imports. That's based on data from the San Francisco Fed. And that's imports of all types, so even including crude oil that obviously isn't affected because it's coming primarily from Canada. So I'm not really worried about this from an inflation standpoint. I'm more worried about it from a sort of cascading disruption standpoint if we're looking at a multi-week disruption taking place.
Jason, I know you've dug into this a little bit, and if we do see a strike, you were able to kind of figure out what sectors or maybe what products would be hit the most. What did you find there?
Yeah, so apart from auto parts, as consumers, the biggest one that sort of jumped out to me is actually bananas. We've imported so far this year over 2 million metric tons of bananas. And most of those, about 2/3 to 75%, come in through the East and Gulf Coast ports because this is what we call a low value density item. It's something that you need to get it close to the final market with the most efficient transportation mode possible, which is containerized water in this case. So you can't reroute this product all through the West Coast and, truck bananas from Southern California all the way to, let's say, New York City. That's not a profitable endeavor. And so it's also a product with a short shelf life. And so that would be the one where if I was a consumer and as a consummate consumer of bananas myself, I'm looking at saying, okay, that could be one that if there's a multi-week strike, it could be hard to get the quantities that folks are used to just because it's a perishable product. And so from the everyday consumer standpoint, that's probably the one you feel the most. But a lot of other goods, we've already sort of front-loaded a lot of imports. So I don't see the holiday side of things being too disrupted at the moment.
All right, Jason Miller, thanks so much for joining us here this morning to break this down. Michigan State University Supply Chain Management professor, we appreciate the time.
Thank you for having me.
Coming in next, we got much more of your market action ahead. Just about 90 minutes into the trading day, and take a look at the major averages. Not too far from the flat line, although we are seeing the Dow now back in positive territory. The S&P off just about 0.1%. We'll be right back. Caroline Ellison, a former top executive at FTX, will be sentenced today after pleading guilty for fraud 2 years ago. Prosecutors have told the court that Ms. Ellison deserves leniency for her, quote, extraordinary cooperation in the investigation, now while also testifying against FTX CEO Sam Bankman-Fried. So, this is interesting because when you take into account how critical she was as a start witness in this trial here, many are saying that she might be able to avoid jail time. She might get a softer sentence because of her cooperation. But critics, though, are saying that, hey, she wasn't a whistleblower. She could have stopped this at any time. She didn't. She didn't stop the fraud. She then cooperated with authorities after the fraud was brought to light. So maybe she shouldn't be getting as soft of a sentence that some are expecting. So, of course, we will closely be watching to see how this all plays out. But again, her role in this trial, in the testimony against Sam Bankman-Fried was one that we were tracking very closely here at Yahoo Finance.
Yeah, and in huge contrast to Sam Bankman-Fried, she's really kind of withdrawn from the public eye since the downfall of FTX. And, you know, in the kind of 24-hour period where there was a lot of chaos at the firm, she was known to speak with a co-founder of Facebook about some of the challenges. SBF had asked her to transfer funds to the Bahamas, which she denied. But to your point, Shauna, there were other things that she kind of acquiesced to throughout her time there. I think it's interesting a former Manhattan Fed prosecutor spoke about this and said that because of her collaboration, she may not actually face jail time. But we have seen, of course, several other members who are involved in this getting a significant amount of jail time, so we will see. Another story we're watching, ByteDance announcing they will be shutting down TikTok Music at the end of November, just 2 years after launching the music streaming service. The company is telling users about the service, originally meant to compete with Apple and Spotify, that they should transfer their playlists over to other services by the end of October. And I think it's actually by the end of November there. But having said that, I do want to give a little bit of context here. So what's interesting about this is that this comes after ByteDance has been in a little bit of a back and forth with some music labels, right? They were struggling over details of rights to music on the platform as early as 2022. And this was seen as an attempt from TikTok, particularly in just individual countries that had TikTok Music, as a way to potentially beef up their own on-platform music offerings in competition with these record labels. A very high bar, one that they perhaps did not actually end up meeting. And then in May, they were able to reach a deal with Universal Music to get music back on TikTok from the likes of Taylor Swift and Drake and Chappell Roan as well. And this deal involved a higher royalty for musicians. So something that hit a little bit both of those sides.
Yeah, so it looks like they're going to be partnering with music streaming services instead of trying to compete with them. They're going to allow users to still be able to add their songs that they like to the playlist of Apple Music, of Amazon, some of those competitors out there, including Spotify as well. But they're no longer going to be going head-to-head or trying to go head-to-head with them in those regions. All right, let's move on to our last trending story, and that is Levi's. Levi's is teasing a new collaboration with Beyonce over Instagram yesterday, which caused the clothing company's stock price to briefly spike on Monday afternoon. The post featuring an image of a woman riding a horse with the caption, "Introducing a new chapter." Beyonce, whose country album earlier this year included the song Levi's Jeans, was also tagged in the post. So there's lots of excitement. We know that Levi's, in an earnings call earlier this year, talked about the Beyonce effect, the impact that it had on the business. We saw the stock rise as a result, or helping the stock rise as a result of that. So this could be big news here for Levi's.
A Cowboy Carter themed Levi's sponsored tour. I'm buying tickets, certainly, if I can afford them. We'll see how much it is this time around. But thank you all for joining our show Catalyst today. Coming up, Wealth is here. We are dedicating that show to all of your personal finance needs. Our very own Brad Smith is going to have you right here for the next hour, so stay tuned.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Hey, our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. On today's show, 2 student loan programs are set to expire on September 30th. We'll break down everything that you need to know if you still want to enroll. And we're discussing 3 lessons from history that can make you a better investor. Plus, Americans are leaving $27 billion on the table according to one study. But how? We'll tell you the reason and how you can avoid it. All that and much more coming up on today's show. But first, let's do a quick check of the markets. We're 90 minutes into today's trading session. Stocks right now losing a little bit of steam after weaker than expected consumer confidence data came out in the last hour. Now, the decline was the largest in more than 3 years, this according to the Conference Board. We will note that the cutoff data for the preliminary results was September 17th, right before the Fed's decision to cut rates by 50 basis points. Here to dig into the numbers and the market reaction, we've got Burns McKinney, NFJ Investment Group Managing Director and Senior Portfolio Manager here with us. Great to have you on the program. So, what are the markets trying to get ahead of, or at least trying to price in on the back of some of this consumer confidence data here, Burns? Okay, we're going to try and get Burns. We're going to try and get Burns back here in a hot second here. We're going to be right back on the other side of this break. We'll swing back to our portfolio session in a hot second, but first we got to talk about this. It's a big day for Novo Nordisk here. CEO Lars Jorgensen is testifying on Capitol Hill over the drug maker's GLP-1 prices. Here with more, who's been keeping tabs on this and on the pulse of it, Yahoo Finance's own Anjali Khemlani. Anj, what do we know so far as this plays out?
So far, we know that everything is going as expected.
Okay.
You've got the senators, really grilling the CEO of Novo Nordisk, Lars Jorgensen, about what the prices are and why they're so high. Lars has fought back with what we know is the list versus net price of the PBM, world and how that works. He did say in particular that for every dollar that Novo Nordisk makes, they give 74 cents to the PBM. So 74% of that is going there. And so that's why the list prices are so high. And also, of course, favorable pushing of the drugs and favorable listing of the drugs in formularies based on those higher prices, because that's where the PBMs make their money. Now, on the flip side, you've got the Senator Sanders talking about what they're doing not being illegal. That's just part of the American system, but he's trying to get it lower to increase access. Here's what he had to say at the start of the hearing.
What they're doing is perfectly lawful. They are simply taking advantage of the fact that, until very recently, the United States has been the only major country on earth not to negotiate the cost of prescription drugs. In other words, Novo Nordisk and other drug companies, not just Novo Nordisk, can charge us as much as the market can bear.
And often what the market can bear is, of course, better for stocks, as we know, because then the revenue comes in and that increases their prices. It's interesting to note also that in the written testimony, which I had a chance to look at, Lars also particularly focused on the investment in manufacturing. That is $30 billion committed to increasing, in particular, the manufacturing of GLP-1 drugs, and noting that that is more than the U.S. space program, which I thought was an interesting tactic to take.
Yeah.
I think the idea is in defense, like, look at how much we're, putting into committing for the people.
Right.
But I don't know that that was the way you wanted to go around it.
So what is the likelihood that this hearing results in lower prices of GLP-1s?
I mean, if they can get, Senator Sanders also noted that he's got commitment from PBMs that if they lower the prices, then the PBMs will increase access. Now, what does that mean? Does that mean a specific number? Have they talked about that? It's a very broad statement and very easy to say, but I don't know that there will be a way unless the U.S. government takes the route of forcing it. Senator Sanders has said he has heard from manufacturers that can produce generics for $100 a month or less. And we do know that Ozempic is slated to be on the CMS's, on the Medicare drug pricing negotiation list in the coming year or two. So it's really up in the air. The likelihood of some real actionable action is very limited at this point.
All right. I saw you watching this on the way into the studio. Yes. It was playing out. So thanks
Still
so
watching
much
it right now.
for sparing some time. She is actually taking a look at her screen. Anj, thanks so much. Appreciate it. Turning back to our strategy session here, let's do a quick check of the markets. We're about 90 minutes into the trading day. There you're taking a look at some mixed activity. The Dow Jones Industrial Average up by about 0.25%. S&P 500, that is down, flat, just barely to the downside right now. And the NASDAQ, you're seeing that flat, just barely to the downside as well. So losing some steam after weaker than expected consumer confidence data. The decline, the largest in more than 3 years, according to the conference board here. We will note that the cutoff data for the preliminary results, that was September 17th. What happened then? Yeah, that was right before the Fed's decision to cut rates by 50 basis points. Here to dig into the numbers and the market reaction, we've got Burns McKinney, NFJ Investment Group, Managing Director and Senior Portfolio Manager here. Burns, great to have you here with us this morning. First, just take us into what the consumer read-through is more broadly. It's come up as part of the inflationary picture as well from Fed Governor Michelle Bowman earlier here this morning as we got those remarks, and then now continuing to try and get a sense of where consumers and how consumers are doing battling up against inflation.
Sure. And today's consumer confidence numbers were a bit weaker than expected. They were down. I think it's instructive to note that one of the key reasons for that has a lot to do with inflation, that not necessarily the inflation we're seeing today or yesterday, but really just a buildup of higher prices over the last 2 and 3 years, as well as the fact that we do have signs of job weakness. That said, I think it's also instructive for investors to note that whereas the unemployment rate has risen from 3.5% to 4.2%, you really need to dig into why it's been rising. And it hasn't necessarily been rising because of people being laid off as much as it has that more entrants into the workplace. And likewise, we're not quite seeing as many additions as we had during the sharp comeback from the pandemic. And so, Jay Powell noted last week that although the economy and labor is softening, but it still remains fairly strong.
When you hear quotes like this from the chief economist of the Conference Board saying September's decline was the largest since August of 2021 and all 5 components of the index deteriorated, how does that impact the investment thesis around the consumer right now?
Well, the first thing that we like to tell our clients is, we definitely always caution against reading too much into one data point. We really prefer, smooth things out and look at, really where the trends lie. And, the consumer has continued to be fairly strong. That said, you also have a situation where, from an investor standpoint, valuations have gotten rich enough that any softness you do see could lead to possibly more muted returns going forward.
So with that in mind, part of your thesis here is despite the recent rally that we've seen, you say we should expect volatility ahead. To what extent? I mean, we're not getting back to early August volatility levels, right?
No, nothing like we've seen there. But at the same time, you still do have enough factors, enough uncertainty in the markets that could drive higher volatility. First and foremost, we do have a very uncertain election coming up in the next 5, 6, 7 weeks. And on top of there being uncertainty around the election, there's just uncertainty as far as whether we're even going to know who won that election on the day after. So between that, there's still geopolitical situations, in Europe, in the Middle East. And so volatility should remain somewhat elevated. That's one reason why we've been focusing a lot on places like dividend paying stocks. Those are the type of the names that, whenever, capital gains go up and down or stock prices go up and down, the dividend component of return is the one thing that adds a little bit of stability to client portfolios.
Certainly. And then with that in mind, some of the companies that have been most in focus have really been annexed to this theme of artificial intelligence to this juncture in the run-up over the past year and change. When we've seen past rate cutting cycles, tech has been one of the beneficiaries. Do you expect that to be the same? And how much more legs, perhaps, does the AI trade have with that in mind and hoping that maybe history either repeats itself or at least rhymes a little bit?
Well, yeah, the key theme to this bull market has been the AI trade. That said, one of the things that we expect to see going forward, really specifically now that the Fed has begun its rate cutting cycle, is a little bit of a broadening of those gains, a sharing of the wealth, if you will, to places that do tend to do well when the Fed cuts rates, specifically if they cut rates, not necessarily out of weakness, but out of a position of strength. They're not necessarily reducing rates to stave off an imminent recession, but rather simply because the inflation adjusted rate, as inflation has really pulled back, has gotten a bit restrictive. And so when you see central bankers making cuts in these instances, it does tend to lead to gains in some of these other places in addition to tech. Places like cyclicals often do well, value stocks do well, some of the banks, as well as perhaps stocks overseas.
We certainly do enjoy some sharing of the wealth. Of course, that largely the ethos behind the show. Burns McKinney, who's the NFJ Investment Group Managing Director. Thanks for taking the time here with us today.
Thanks for having me.
Certainly. We've got 2 key student debt relief programs set to expire at the end of the month, including the Fresh Start program and the on-ramp to repayment. Now, this means that borrowers who are struggling to make payments may need to take action now. Here to discuss, we've got Leslie Tane, who is the financial attorney and author of the book Life and Debt. Leslie, great to have you back on the program here with us. Okay, so some of these key timelines here set to expire here. Where should people be apt to take action at this juncture, especially thinking about the Fresh Start federal loan program?
To take advantage of the Fresh Start loan program, you would need to act immediately. It's set to expire September 30th. That means that if you have a defaulted federal student loan and you would like to be a part of this program, you need to act quickly and sign up for that program.
And so with that in mind, as we're taking a look at what this would mean, what type of alleviation would this provide to anybody who opts into the program?
If you opt into this program, your loans can immediately come out of default status. They will update the information on the credit report to current, and they will allow you to continue borrowing. Defaulted student loan borrowers cannot continue to borrow. So if you're still in school and you need loans, you'll be barred from doing that if you don't get your loans out of the default status.
Why September 30th? Why is it ending then?
You know, it's the time frame, it's been ongoing since the COVID-19 pandemic, and there is an endpoint. It's the belief that at this point in time that collection efforts are going to start resuming and that there are a number of programs available for federal student loan borrowers. So now's the time to act to avoid these issues.
Should student loan holders right now, should they be banking on further debt cancellation, or is there something else that they should be doing right now to take action, including the enrollment that we were talking about?
The enrollment in this program is for federal student loan borrowers who have defaulted in the past or are in default status. Those who are not in default status, it's not a great strategy to rely on future forgiveness programs. It's always advisable to be proactive with your federal student loans or your private student loans. If you're struggling, reach out to your lender or the servicer and ask what options are available to you at this time.
And then when we think about the CFPB and some of the actions that they're taking on credit reporting, how does that all play into these broader programs that are being put forward from Fresh Start, and hoping that it also does impact more positively credit scores down the line as well?
Absolutely. The goal really is to help borrowers who have struggled and have defaulted federal student loans, not only to get them back into repayment, but also to update the information on the credit reports so that the credit score can come up and that individual borrower can start to have more opportunities. Those with better credit have better opportunities to borrow, refinance, or even have different types of job opportunities. So the goal overall is to help borrowers and debtors to have better credit scores, and this is one of those such programs.
Leslie, sound information and context as always. Leslie Tane, who is the financial attorney and author of Life and Debt. Good to see you, Leslie. Thanks so much.
Thank you so much.
Absolutely. Guys, coming up, keeping with higher education, U.S. News and World Reports is out with its latest college rankings for 2025, representing one guide for prospective students. The survey is in its 40th year, and it ranks nearly 1,500 colleges and universities using up to 17 measures of academic quality. But enough talk here. The moment you've been waiting for. The top 3 best national universities are Princeton, MIT, and Harvard. Princeton, the top school, has just a 4% acceptance rate, and that's going to run you a cool $62,000 for tuition and fees. Moving to the top 3 public national universities, we have UC Los Angeles, you've got UC Berkeley, and University of Michigan Ann Arbor. Just a little compare and contrast here. In-state tuition fees at UCLA, that'll run you just over $14,000. But if you're out of state, that increases to, get this, $46,000. And cost is a major factor here. So we also want to show you some of the stats that U.S. News released, looking at 20 years of tuition costs at national universities. Adjusted for inflation, tuition and fees at private national universities have jumped around 41%. Out-of-state fees at public schools have risen 32%, and in-state tuition and fees at public schools have grown 45%. Main takeaway here? The college experience is often a family financial decision, and as rising tuition costs have outpaced wage growth for decades, it's more important than ever that students who are going and seeking higher education calculate which program best taps into their passion, but also provides that return on the capital investment. Everyone, we've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Owning a home is as American as apple pie and baseball, yet the promise of achieving the American white picket fence dream seems more elusive than ever. In 2024, the median price for a new home is $495,750, a price that's out of reach for 77% of US households, according to the National Association of Home Builders. The median household income, meanwhile, is $80,610, according to the Census Bureau, suggesting the gap between how much a house costs and how much one can afford remains wide. Even with that gap, experts say real estate prices vary widely by zip code, and there are still ways to achieve home ownership. So how much house can you afford? Here's how to figure that out.
The really obvious factor that affects housing affordability is the home price itself. But there are two other factors that are really important for housing affordability. One is the mortgage rate. The other major factor is, of course, incomes. So those are the three legs of the housing affordability stool.
Of course, affordability is a quality of life calculation, so only you ultimately get to determine what works best for your monthly expenses and budget. But determining how much house you can actually afford starts with some basic details that will help you figure out what your biggest and most important monthly cost should reasonably be. A key first step is to plug the following into a housing affordability calculator. Your household gross income, that's your annual pre-tax income. Your debt, think monthly payments on loans and credit cards. The down payment, a percentage of the purchase price of the house paid up front. The loan term, the duration of the loan. Interest rates, interest paid during the loan term, which can vary based on credit score and market conditions. Mortgage insurance protects lenders in case a borrower defaults. Property taxes, a variable cost paid to local governments based on the value of the home and the land it's on. And of course, closing costs. To start, identify your household's gross annual income and gather 3 months of bank statements to estimate your debt payments. Plug that into the calculator. For this example, let's use $100,000 as the gross annual household income, a bit more than the median, with monthly debt servicing payments of $500. Lenders assess the percentage of your monthly income that goes towards paying your debts, your debt-to-income ratio, to determine your financial health and ability to take on a mortgage.
A lot of people go with the 30% rule of thumb for the housing costs. That's keeping your housing costs to no more than 30% of your gross income. Anything in that range should be comfortable for most people, but like most rules of thumb, you should think about how it applies to you individually.
Next, estimate how much down payment you can comfortably afford. Your down payment is usually the largest upfront cost. For this example, we'll use $10,000. Next, consider the loan term. A 30-year fixed loan is the most popular, where the interest rate stays constant or fixed throughout the life of the loan. We'll use a 30-year fixed for our example. Your mortgage will be your largest ongoing monthly payment. All the information so far and market conditions factors into the interest rate the lender offers. We'll use an interest rate of 5.795% with monthly property taxes and private mortgage insurance of $375 and $100 respectively. With all this data plugged in, a recommended affordable home price for a household with $100,000 gross income comes out to $329,902, while the loan principal and interest is $1,875. The total monthly mortgage payment, which includes property taxes, homeowners insurance, and mortgage insurance, is $2,500. You can adjust the home price accordingly if you want to spend less and see how much financial strain could be added if you spend more than you can afford. One thing to also remember, you need to factor in those closing costs, between 2 and 6% of a home's total purchase price. It's important to note that buying a home is a transaction, while owning a home is an ongoing budgeting consideration beyond the monthly mortgage. Save 1% of your home's purchase price for repairs and maintenance, because that's on you too. And don't forget about property taxes.
Property taxes tend to go up over time as costs for government services rise. I think when people are looking ahead and trying to think about how their housing costs will change over the long run, using a percentage of the home's value when thinking about property taxes or insurance is a good way of accounting for that. It takes time and preparation to get into the housing market. So making those little steps to save and prepare now to get your finances in order, I think that those are the right steps to take. And then, of course, anything you can do to improve your income, whether that's focusing on your career or taking on a side hustle, can also help you realize.
U.S. home prices hitting another high in July, according to the Case-Shiller National Home Price Index. Yahoo Finance's Danny Romero has more on this. Hey, Danny.
Brad, home prices continue to stay stubbornly high, at least in July. The S&P Case-Shiller National Home Price Index reported that home prices jumped 5% compared to last July. Remember, this is a lagging indicator that tracks home prices of previously owned homes. Now, separately, the index tracking the 20 largest cities across the country rose 5.9% compared to last July. Remember, in July, mortgage rates were hovering near 7%. Sales activity was very weak as well during the summer. But the good news is that the pace of price increases is moderating. So that means that we will see those numbers reflect the data eventually. But some industry experts warn that home prices might need to fall at least 15% to spark buyer appetite. Brad?
Interesting. And so regionally, where are we seeing some continued movement or moderation? Or on the other end, where are we seeing the highest price gains?
Regionally, New York continues to post high home prices. On an annual basis, home prices in New York rose 8.8% from last July. Los Angeles, Las Vegas, home prices also gained in July. Remember, again, the pace of prices increases is moderating. So we will eventually see those numbers reflect the data. But right now, for now, Brad, home prices continue to, be a record high.
All right, Danny, thanks so much for breaking this down for us. Teeing up this next conversation, let's stick with the housing data here. Home price growth is slowing according to the latest Case-Shiller Home Price Index. With rates on a downward trajectory, can prices continue to come down even as more buyers enter into the housing market? We will see. But to discuss this further, joining me now is Jessica Lautz, who is the Deputy Chief Economist and Vice President of Research at the National Association of Realtors. Great to have you back on the program here with us, Jessica. So just give us your read-in as we're getting more of the data on where home prices are remaining elevated and what is anticipated as we start to see mortgage rates continue to trickle lower.
Yeah, so I think it's a really interesting housing market right now because as we look regionally, we know that the West is always more expensive, but we're still seeing migration flow into mountain states, into the Sun Belt, and that's pushing up home prices in those areas of the country. We also know that it's really a struggle for first-time home buyers based on affordability to come into the market. So it's really expensive homes where we're seeing strong growth.
And so with this in mind, I'm just taking a look at the S&P CoreLogic Case-Shiller U.S. National Home Price Index, as we were just discussing a moment ago with our reporter Danny Romero. And as we're taking a look at this 5% annual gain in July, that is down from 5.5% in the previous month here. But where most notably are we seeing some improvement, looking for any type of some positivity coming from this despite some of the all-time highs that we had seen in continuity?
Yeah, I mean, I think if we're going to talk about improvement, we need to be talking about the ability for home buyers to actually purchase. And that's really coming from the mortgage market today versus home prices. Because if we look at home prices, they're still ticking up. But when we think about the qualifying income for someone to purchase a home, it's $108,000 nationwide. So looking at improvement, really, we're looking to the mortgage market at this point.
And so with that in mind, what is your anticipation for what it will take on the mortgage side for buyers to really flock back into the market and start to throw some bids in? Because that could be another pressure that keeps prices elevated if you do see so many people come in off the sidelines and bidding wars really starts to become a thing of reality once again.
Absolutely. I mean, if we look over the summer months, we saw that multiple bids had ticked down. We're at 2.4 offers for every home listed right now. But at the really tough peak, when we knew that interest rates were quite low in the 2 and 3% range, we saw 5.5 offers. So I think realistically, we're never going to see that again. But I do think that as rates continue to tick down, perhaps into high fives, low sixes where they are today, we'll start seeing more interest in the housing market. But that has to come from first-time home buyers, because I don't think we're going to get current home owners, unless there's a motivating factor to move, really off the sidelines anytime soon.
What are you seeing in terms of the number of homes that are actually going for asking price and above?
So right now we're seeing 20% of homes in the last month based on NAR's data moved above the asking price. That's lower than what it has been in recent months, but still seeing 1/5 of homes moving more than the asking price either means that it's priced really competitively, or we know that there is still strong demand. And I think what we're seeing is strong demand in the housing market. As rates tick down, we could see those multiple offers come back.
With that in mind, do you think that's some of the buyers trying to price in to their own figures some of the new NAR rules? And what is the early kind of reception as that's beginning to be implemented?
Well, I have to say, talking to realtors, anecdotal evidence, they're embracing the change. They're ready for the change. But as far as home sales data go, we're not going to see it yet, because when we look at August data, what we're actually looking at is the someone who signed a contract a couple months ago. So we're going to have to wait perhaps until the winter months, until we really see late fall, winter months, until we really see that looking like the new change is there.
Interesting, really interesting here. And then just lastly, while we have you, one of the other more interesting things that's starting to play out a little bit more is the number of co-buyers that are entering into the market together, pooling assets, pooling their resources, and perhaps trying to make a more compelling pitch as well as to why they should be able to take over a property. What are you tracking on that front?
Yeah, I love this topic. And I think part of it has to do with the drop in marriage rates in this country. We know only half of Americans are married. So there's a lot more singles, but homes are expensive. And so pooling incomes, thinking about saving together, earning equity together makes a lot of sense, especially when housing in this country is usually 3 bedrooms, 2 baths. So do you actually need that whole house by yourselves as a single buyer? Probably not. So a roommate makes a lot of sense.
All right, Jessica Lautz, who is the National Association of Realtors Deputy Chief Economist and Vice President of Research. Jessica, always a pleasure to grab some time with you. Thank you.
Thank you.
A quick programming note before we head to break. Be sure to watch Living Not So Fabulously. And of course, coming up on the other side of this short break, do you have a sound investment philosophy? We'll discuss the importance of developing one. That's on the other side.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot. Welcome to Stocks in Translation. I'm your host, Jared Blickery. Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement. Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains.
We're on for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Interested in becoming a stronger, more intelligent investor? Our next guest argues that having a sound investment philosophy is critical for all investors, from first-time novices to professional day traders. Here to discuss, we've got Stephen Forrester, who is the professor of finance at the Ivy Business School and author of the new book, Trailblazers, Heroes, and Crooks: Stories to Make You a Smarter Investor. Great to have you here on the program with us, and congratulations on the book as well here. First and foremost, as we're thinking of what you've seen of effective investors over the years, what are traits that stick out to you?
Well, I think, Brad, that it's important to recognize some of the emotions, some of the biases that we have, being able to distinguish between some of these biases. Just to give an example, fear and greed, the emotions that really can take over individuals, can take over the overall market as well. And one of the stories I tell in the book is famous investor Warren Buffett, and he really was able to distinguish this notion between fear and greed. And most famously, he was able to recognize that the best time to invest often is to be greedy when others are fearful, and fearful when others are greedy.
And so with that in mind, I mean, there comes emotion, there comes impulsivity when you hear about a new shining investment opportunity and you say, I don't want to miss out on this. There's FOMO. To what extent are you tracking FOMO levels in today's market?
So that's a great point. We saw that in the last few years with meme stocks in particular, that were really bid up way beyond what would be their apparent fundamental value. This goes way back centuries. It's not just a new phenomena. In fact, Sir Isaac Newton made a lot of money in the stock market, one particular stock, South Sea stock, and sold out, and then watched the stock continue to climb. And he experienced FOMO, and so he jumped back in probably at the worst time. So we've got to be able to control our emotions, and once we've sold a stock, that's it. No regrets, just move on.
And so with that in mind, there's also kind of this management of overconfidence that investors would be apt to implore. How can one effectively go about inserting that into their portfolio strategy?
Where this often comes into play is trading, and studies have shown that if we are overconfident in our abilities, we tend to trade more. And there's actually a gender gap. Males tend to be more overconfident and tend to consequently, based on some studies, tend to underperform. So we really have to do a reality check and try to keep our overconfidence in check.
And so with that in mind, on the other side, it's easy to, when you have a trade or an investment that you feel is going sour, how do you manage that confidence that has waned and then make sure that you're either staying invested or identifying better investments?
So this comes back to this whole notion of investment principles. What are our beliefs? What are the principles that guide us? And so it's important to develop those, and some important investing principles, of course, are diversification. You have to recognize that it's not easy to outperform the market. You've got to take into account risk. So having a long-term perspective is very important as well. And so that's where we've seen many cases where investors sell in a panic when markets have gone down. I tell the story about October 1987, which was the worst one-day drop in history, with prices going down by more than 20%. Had you held on, we would have seen a very nice recovery in terms of the prices. So it's trying to remain calm, having a plan, having a long-term focus.
Yeah, trading session that later on prompted so many different exchange regulators to make sure that there were either limit up, limit down rules or market-wide circuit breaker rules in effect. Many of them came into play during the COVID pandemic and the onset of that, as we remember as well. And then just lastly, while we have you here, you outline within your book as well 3 levers to achieve financial goals. Can you break those down for us?
Sure. The three levers, very simply, are how much we're going to save and invest, how long we have to save and invest, and what kind of return that we expect. So those are the levers that you have. So you start with your goals, you turn those into financial goals. Maybe it's saving for education, maybe it's for retirement. The more you save, then the quicker you'll get to your goals. But that might involve some trade-offs. That's going to involve some sacrifices today. Then the next lever is how long you have to invest. You might have an initial goal of wanting to retire at age 60, but if you have some flexibility, perhaps you can revise that and spend a little bit more time and not retire till you're 65. The last lever is then what kind of expected return you're going to get. And so this really drives what your portfolio is going to look like. Take some big asset classes, the traditional asset classes, stocks and bonds. This is where you face a real trade-off. You'll get a higher expected return based on history in terms of stocks versus bonds, but you're going to take on more risk. So back to the other levers, the more you've saved, the longer you've saved, then you don't have to take on as much risk.
Stephen Forrester, who is the professor of finance at the Ivy Business School and author of the new book, Trailblazers, Heroes and Crooks, Stories to Make You a Smarter Investor. Thanks so much for taking the time here with us today.
Thanks, Brad.
Certainly. Coming up, everyone, we're checking in on Main Street with the MetLife and U.S. Chamber of Commerce U.S. Chamber of Commerce Small Business Index. That is next on Wealth. Over the past 2 years, restrictive monetary policy helped slow inflation's growth, but for folks on Main Street, the pressure is still on. Far and away, inflation remains a pain for small business owners. Over half cited it as a top challenge in the MetLife and U.S. Chamber of Commerce's third quarter small business index. This is the 9th straight quarter in which more than half of respondents said inflation was their biggest worry. With more, I'm joined by Neil Bradley, who is the U.S. Chamber of Commerce Executive Vice President and Chief Policy Officer here. Thanks so much for taking some time here with us, Neil. First and foremost, as you think of the pulse of small business right now, going into the election and after the Fed's first rate cut in 4 years here, what are small business owners feeling and navigating through?
Well, Brad, thanks for having me on. It really is kind of a take two cities, if you will. On one hand, the economy and inflation, as you just pointed out, remains far and away the number one issue for small business owners. They're concerned about the broad direction of the national economy, a little less concerned about their local economy. But then here's the other story that they're telling us. When it comes to their individual business, they're incredibly bullish and optimistic. So let's take, for example, revenue. We have about 71% of small business owners who tell us that they expect revenue to increase over the next year. That's a series high dating back to 2017 when we started this survey. 44% tell us that they intend to expand their staff and hire new employees over the course of the next 12 months. So when it comes to their individual business, they're pretty bullish. They're just worried about where we're going nationally.
That's really interesting. What type of policy are small business owners anticipating then to continue to keep their businesses in more optimistic straits?
Well, I think what they're really hoping for, frankly, what all of us are hoping for, is that we've managed to beat inflation, that we're done with these kind of rapid increases in prices, that we have more price stability going forward. I think they're very much looking for that. They're looking for more certainty out of Washington. Interestingly, in this survey, we also asked about people's interest in the election, and we had 71% who said they're more interested in this election than they were in the last one. 42% much more interested than they were. But here's the interesting thing. When it comes to government, they're tired of the gridlock. They say that gridlock in Washington is actually an impediment. It's something that they worry about. 3 in 4 small business owners say that we need elected officials who want to compromise and resolve some of these issues so that we have more policy certainty going forward.
That's really interesting. You know, while we have you here, it's an environment where small businesses are always needing to make sure that they're up to date on the latest technology and employing that for their businesses. And it was particularly interesting to see how many small businesses are looking at what their options for artificial intelligence are. What did you take away from how some of the small businesses are anticipating their opportunity to increase productivity or to insert that in their business somehow?
Yeah, I think this is one of the great overlooked stories when it comes to artificial intelligence. We tend to think of these big established companies that are using AI. Our own survey data and roundtables, focus groups that I've done with small business owners, leads us to conclude that the actual edge use case are these small business owners. They're already figuring out how to use AI to improve their efficiency, to bring tasks in-house. And so I was talking to a restaurant owner who said, they used to outsource the production of their menus, the redesign of their menus when they change products. Now, thanks to AI, they do all that in-house. They're targeting. I talked to a retail store owner. Their ability to get more efficient in targeting who they're going after in terms of email communications for new business is much more efficient than it used to be. And so I think what we're going to find is that small businesses who've had one of the hardest times hiring in this tight labor market are going to be some of the first adopters of how we actually make AI a practical tool to improve efficiency.
Neil, just lastly, while we have you, I got about 30 seconds left here. We are facing a potential government shutdown. We were checking out, and our producers are keen on keeping a close tab on your Twitter, your X profile, and you were saying that Congress is going to avoid a government shutdown, but a possible port strike could really impact small businesses here. What's your read through there?
Yeah, we are going to avoid a government shutdown. Congress is going to government open. But the way it looks today, the East Coast and Gulf Coast ports that are represented by a longshoremen's union are threatening to close all of those ports beginning next Tuesday. To put in context what that means, more than half of the nation's imports and exports go through those ports. If you even have 1 or 2 days of work stoppage, you remember those visual images from the container ships stacked up in the West Coast ports? That's what it's going to look like on the East Coast. That's a huge supply chain disruption. That's going to be inflationary. This is the type of unexpected shock that could really hurt businesses across the country and especially on Main Street.
Neil Bradley, U.S. Chamber of Commerce Executive Vice President and Chief Policy Officer. Neil, thanks so much for taking some time here with us today.
Thanks for having me, Brad.
Certainly. Well, the latest read on the consumer shows confidence falling in September. Yahoo Finance Morning Brief and Catalyst co-host Shauna Smith joins me now. She came back for Wealth.
I did. I wouldn't miss it.
Oh, my goodness. Thanks so much for
timing.
Well, I mean, you're a consistent viewer for here, so we got to bring you back on here as a guest as well. What do we know?
The most loyal viewer, I'll point out. All right, well, let's talk about consumers right now. Well, they are a bit wary. If you take a look at the data that was out this morning, consumer confidence, it actually fell for the month of September, its biggest drop in nearly 3 years. Now, the shift in sentiment weighing on the broader market today. But when you take a look at some of the other surveys, today's downbeat reading isn't necessarily consistent with what we are seeing elsewhere. Despite some of that worry about sticky inflation, we've talked a lot about a sluggish and softer economy and a softer jobs market. A new survey out from Vanguard found that investors are still optimistic. Let's look at some of the findings here. Investors are confident in the market's trajectory over the next 12 months, expecting a 6% return. That's slightly better than what we saw in the June reading. The same is also true for the longer-term outlook. Investors expecting returns of 7.9% over the next 10 years. Now, the reason why that number is significant, it's actually a record high for this survey. Now, this talk of a risk of a recession might actually be overdone. When you take a look at the findings of this survey, it found that the estimated probability, at least in investors' minds, of an economic disaster within the next 3 years, that actually fell in August. That was down to 4.4% versus the 5% reading that we got back in June. And finally, the massive global sell-off on August 5th that pushed the NASDAQ into correction territory, well, that didn't seem to rattle investors either. The survey finding that most investors actually sat it out on the sidelines. They didn't panic. They didn't sell. And those that actually were brave enough to adjust their portfolios that day, nearly 3/4, 73%, used it as an opportunity to buy. So what does all of this signal? It's a sign of confidence in the market's long-term momentum, something that we have talked about time and time again, Brad, with so many of our guests here over the last several months on Yahoo Finance. So yes, there is reason to be, I guess, a little bit worried about some of the data that we are getting out like this morning, that drop in consumer confidence. But when you take a look at those investor surveys, it still seems like investors have a lot to be optimistic about.
Yeah, exactly. I mean, I was shocked when we heard from one of those guests here, Robinhood CEO on Wealth, who said we're seeing more buying than selling in August despite that volatility. He came on just in the midst, in the aftermath of all of that taking place, and said that. And so spot on with what you just broke down
sell
for us.
high.
Well, I'm trying. We're trying here, Shauna. Thanks so much. Appreciate it. Everyone, just before we let you go, we teased this at the top of the show. We had to circle back on this one. Ever find a stray gift card in your wallet? You're not alone. 43% of people have at least one unused gift card, voucher, or store credit, a nationwide total of about $27 billion in outstanding value, according to a Bankrate survey. Furthermore, over 1/3 of adults have lost money thanks to a gift card misstep, like letting a card expire, or losing a gift card, or having a store credit, or seeing that store go out of business. The generation with the highest outstanding value? Millennials. On average, this generation has over $330 per person in unused gift cards, vouchers, or credits, followed by Gen X and then baby boomers, according to the same survey here. And the average among Americans of all generations is $244 of unused credit. That's up from 30% last year, up 30% from last year, rather. So despite so many gift cards not being used, 84% of people say that they've given somebody a gift card, according to Bankrate. Gift cards are the second most popular holiday gift last year, according to the NRF. So before you go holiday gift card shopping, you might want to think twice twice because it might end up being a waste, unfortunately. And if you have gift cards or think you have them, check those drawers, man. Make sure you can find them. That's it for Wealth, everyone. I'm Brad Smith. Thanks so much for watching. Stay tuned for Market Domination with Julie Hyman and Josh Lipton coming up 3 p.m. Eastern Time. You don't want to miss it.